So I hope you have gone through the pre-scene number of times, read it, understood, analyzed. So because of that, I'm not spending time to go through the pre-scene again. Instead of that, so I'll take the important areas which are relevant to the financial reporting aspect of the paper and what would be the possible questions that can be tested in terms of the examination, right? December 2025. You know that this would be the final session under the current curriculum, so that it's pretty important for you to focus during these few days on your studies and ensure that you complete the paper SL1 in this examination session. Right, okay, with that note, let me go to the content of the presentation. So there are 4 areas which I'm going to cover. First of all, introduction, then accounting standards which are relevant for this particular pre-scene, consolidation, and finally analysis and the interpretation, ratio analysis, which can be tested in terms of the examination, right? So the introduction, this is about the company mainly, right? So the name of the company is actually Healthcare PLC, right? So the business what they undertake is private healthcare service provider. So mainly company has hospitals, 3 hospitals. In addition to that, they have a company which provides laboratory services. Okay, so it is into the healthcare service provider. So then if you look at the important aspects in terms of the timeline, events taken place. So the company was established in 1983. So initially it was a private limited company located in Colombo, right? Name was Healthcare Private Limited. Then in year 2000 it was listed on Colombo Stock Exchange, and the name of the company then transformed into Healthcare PLC. So in this pre-scene analysis, so it is referred to as HC, Healthcare PLC. So then Healthcare PLC, in addition to that, like initially it was a hospital operation, and thereafter, so there was a laboratory, there's a company which provides actually laboratory services. So the Healthcare PLC owns Healthcare Laboratory Private Limited. It's a separate company, fully equipped, internationally standard laboratory, right? So in terms of this healthcare industry, so you need to do a lot of medical test, right? Medical testing is required in terms of the patients. So that for that particular thing, what they have done is they have established a separate company called Healthcare Laboratory Private Limited. So but it was not mentioned when they have started Healthcare Laboratory Private Limited. Doesn't matter. It is established as a separate company. That particular information was given in the pre-scene. Then one of the significant event taken place is actually in 2018, right? 2018, company acquired 100% stake in 2 nursing homes, right? Healthcare PLC acquired 100% stake in 2 nursing homes, one located in Kandy, other one is located in Mathura, and changed the names of the 2 nursing homes after the acquisition to Healthcare Kandy Hospital Private Limited and Healthcare Mathura Hospital Private Limited. So what they have done is what they have done is they have acquired 100% stake in 2 nursing homes, right? So in Mathura and Kandy, because initially this particular business was located in Colombo. So the first hospital is the one what is started in Colombo. Then they wanted to move into the regional areas. So as a part of that strategy, what they have done is acquired 2 nursing homes and converting them into hospitals. So in this particular pre-scene, I will refer them as Kandy Hospital and Mathura Hospital, right? And the name of the companies are given: Healthcare Kandy Hospital Private Limited and Healthcare Mathura Hospital Private Limited. Now the group structure is clear, right? So the parent company is what? Healthcare PLC. We'll look at the group structure in a little while, or even I can go there and come back. So the parent company is what? Healthcare PLC, which has 3 subsidiaries. All are 100% owned. So in terms of the Kandy Hospital and the Mathura Hospital, it was clearly mentioned in the case study, those are 100% owned subsidiaries. That was given in the pre-scene. But in terms of the laboratory, it was not mentioned whether it is 100% or 80% or the percentage is not given, but based on the information given in the pre-scene, if you look at consolidated financial statement of Healthcare PLC, especially consolidated profit and loss and the other comprehensive income, you will realize, as well as the consolidated statement of financial position, you will realize that there are no non-controlling interest. So there are no non-controlling interest means, obviously what should happen is, so these all 3 companies should be owned 100% by Healthcare PLC. That's why there are no non-controlling interest. So the entire profit is attributable to the equity holders of the parent, and even the entire equity in the statement of financial position is attributable to the equity holders of the parent, which means there are no non-controlling interest. So in the sense, what it means is all 3 subsidiaries are 100% owned by the parent company. Okay, right. So Healthcare PLC, Laboratory Services, Kandy Hospital and Mathura Hospital. Okay, right. Then information about the share capital, right? Share capital of Healthcare PLC, number of shares are 300 million shares. Value per share is 10 rupees. This is the par value of the share. Then the total value of the share capital is 3000 million or 3 billion. That is 300 million into 10 rupees. 3000 million or 3 billion. Then if you look at the market price per share that was given in the pre-scene as at 31st March 2025, as at the reporting date, 52 rupees per share. Okay, right. Then ownership structure is also given in the pre-scene. So if you look at the share capital, 23.33% is owned by Dr. Senaka Atukorla, chairman of the company, right? And he is actually the founder of this business. Then thereafter, 3 of his friends initially started Healthcare Private Limited, right? So are having how much of percentage? Dr. Sanjay De Silva and Dr. Sunil Madhavage. So both are executive directors. They are having 13.33% each. Thereafter, Dr. Vasantha Pereira, he is also an executive director. He is having 10%. Then Dr. Prabhat Jayasinghe, he is the CEO of the company at the moment, who has 5% of the share capital and remaining 35%. Now if you look at 23.33 plus 13.33, then 13.33, 10%. So that comes to 65%, including CEO's 5% holding. If you add all these 5 individual holdings, so it is actually 65%. So the remaining 35% of the share capital is held by public. Okay, so this is the ownership structure of Healthcare PLC, right? Right. So group structure we looked at, right? Group structure we looked at. So right, up to now I hope you are clear. So this is the introduction of the pre-scene analysis. Probably you are aware, but I wanted to summarize everything what is there in the pre-scene. Right, now we are moving to the important area of the discussion. That is, what are the possible areas of accounting standards? What are the possible accounting standards and what are the possible areas in those standards that can be tested in your examination? So in terms of the presentation, I will share the presentation with CASriLanka. They'll share the presentation with you, right? So because of that, you don't need to write down what is there in the presentation. Focus on the lecture, pay full attention. So definitely you will be getting the presentation, right? So moving to the accounting standards. So let's take the important areas of the pre-scene, right? So these some of these points are taken directly from the pre-scene. So then look at how these areas would impact onto the paper in terms of the accounting standard, right? So one of the thing what is mentioned in the pre-scene is HPL offered an integrated health service that utilized modern diagnostic tools and advanced medical equipment, most of which had never been used in the country before. So when this company was started, this private healthcare was not popular in the country, right? So basically this part is taken to explain you that the company is in the healthcare service business, right? They use a lot of modern equipment, right, which have not been used in the country. So basically I just want to tell that, so they are into healthcare business, that I anyway explained at the time of the introduction as well, right? So then one more thing, basically first of all I am getting into the business lines that they are into, right? So through that we'll look at, okay, what are the implications in terms of the accounting standards. It also says that HP owns Healthcare Laboratory Private Limited. Yet again we looked at the introduction, fully equipped international standard laboratory that conducts wide range of diagnostic tests, both in-house. So you have in-house as well as outpatient clients. So they are into laboratory service. Earlier, health services. Owing to the high reliability and accuracy of its test results, laboratory has earned strong recognition within the medical community and is often recommended by healthcare professionals. It's a good company, so accurate test results. The laboratory generates significant revenue and has expanded its reach through a network of collection centers. So there are a lot of collection centers located in suburban areas as well as major cities, including Kandy, Matara, Galle, Gampahak, Kegol, Kalutara, Panadura. So there are collection centers, sample collection centers. For sample collection, only the two hospitals in Kandy and Matara reimburse their actual collection cost. So the two hospitals in Kandy and Matara reimburse for the actual collection cost. Entire collection is getting reimbursed for these two hospitals, because might have been, so in Kandy and Matara, so these two hospitals collect the sample as well as they provide the laboratory services by those hospitals itself. So because of that, entire amount what is collected from the customer belongs to these two hospitals, Kandy and Matara hospitals. All other collection centers compensated with 10% commission. All other collection centers are getting only 10% commission on the total value of laboratory tests routed through them. On the other hand, other collection centers, they don't have hospitals. What do is they collect the samples and send to the Colombo hospital, right? So the Colombo hospital is carrying out the testing and the reports are maybe again disseminated through these collection centers. Now in terms of these collection centers, other than what is collected in Kandy and Matara hospitals, in the other collection centers, what they are entitled is only 10% commission. Right? Now let's say there's a particular test, so where the cost of that particular test to the customer is, let's assume 1000. Out of that 1000, only 10%, which is only 100 rupees, is paid to the collection centers. Remaining 900 to the Colombo hospital, right? So we need to look at the implications of what? Principal and agent relationship. I'll discuss about that, right? I'll discuss about that once I go through, right? So basically in these two slides, what I wanted to highlight is couple of things. One is the businesses that they are into, which we already know, healthcare service, which means hospitals, and laboratory services. In addition to that, so there's a particular area where this principal agency relationship would come into play. Right. So the important accounting standard what is applicable in this situation is what? SLFRS 15, revenue from contracts with customers. I hope now you have already gone through, if you have gone through the annual reports of the companies which are in this hospital operation of the country. There are a number of hospitals, right? Navaloka, Denasiri, Durdens, Lanka hospitals, right? There, if you go through the audit reports of these companies, right? I'll come to those, some of these audit reports at the latter part of the discussion of SLFRS 15. So if you look at the audit reports of all these companies, the key audit matter, or there are few key audit matters. One of the key audit matter, actually that is the first one in most of the companies, is in terms of the revenue recognition. Because in case of a hospital, revenue generation is complex. Why? The pricing formula. Now if you go to a hospital, until the patient, let's say if you are admitted to a hospital, so until you are discharged, you don't know what would be the price, right? It is so complex because there are multiple transactions, okay? So the multiple services provided by the hospital and the pricing formula is complex. On the other hand, if you look at the hospital, number of transactions, so the volume of the transactions are really high, okay? Then most of the time it is computerized environment. There are different locations. So the IT aspect and the ERP aspect, where there are a lot of issues in terms of this particular pre-scene, where it has been identified, right? Because in terms of the ERP system, there are a lot of areas where you need to fix, right? Billing system to inventory issue, right? So what I want to tell you is, revenue recognition is important because a lot of IT related matters are involved. Okay. Then plus, I already explained to you, and I will discuss that in detail. With regard to the revenue recognition, you have to look at principal and agent relationship. Okay, principal and agent relationship. Now, for example, let's say you channel now look at this from the perspective of the hospital. You channel a consultant, a doctor, right? Then when you want to channel a consultant, a doctor, you make a payment. Let's say you pay that to the hospital. Let's say you pay 5,000 rupees. Now the question is, can hospital recognize that 5,000 rupees as its revenue? Because that 5,000 rupees include the consultant fee as well as hospital charges. So let's say out of that consultant fee is 4,000 rupees and the hospital charge is only 1,000 rupees, then the question is, the revenue that has to be recognized by the hospital is whether it is 5,000 rupees or whether it is only 1,000 rupees. If you are the principal, what is the revenue to be recognized? If hospital is the principal who has the primary obligation of providing the service, in that case the revenue has to be 5,000. But if you are the agent, the revenue has to be only limited to your part, that is only 1,000 rupees hospital charges. So likewise, as I mentioned, there are a lot of complexities, complex pricing formulas, volume of transactions are really high, then IT controls, IT environment, okay, then this principal agency relationship, and there are different types of transaction like inpatient, outpatient. So because of that, as I mentioned, if you look at the audit reports of all these hospitals which are public quoted companies where the annual reports are available, so you see that the first key audit matter is the revenue recognition. And in terms of this particular pre-scene, if you analyze, you will understand in terms of the accounting standard, there are not much of areas where examiner can test. So the area which is probable for your examination is actually SLFRS 15, revenue from contracts with customers. Right. So I'm not going to spend time on this, right? You know, in terms of any particular or any transaction, when you are recognizing the revenue as per the standard, you need to follow these 5 steps, right? So step number 1 is to identify the contracts with the customer. Now in terms of the hospital, so you have to identify there's an agreement between the hospital and the patient. Customer is the patient most of the time. Then identify what are the performance obligations. Now in terms of a hospital, there can be different types of performance obligations, right? Inpatient, outpatient. Then there are pharmacy where you sell medicine, laboratory services. Okay, some patients are admitted to the hospital. So what are the performance obligations within the contract? Then determining the transaction price. What is the consideration that you collect from the customer? Then allocate the transaction price to the performance obligation. If you have number of performance obligation within the same contract, then you need to allocate this particular transaction price to each of the performance obligation. And finally, step number 5 is to recognize the revenue once each performance obligation is satisfied. Now in terms of the revenue recognition, we know there are 2 approaches, over time and point in time. Now before I move to the annual reports of these companies or the hospitals what I spoken about, I just wanted to, I'm not going to go through everything, right? As I mentioned, in terms of if you look at the step number 5, out of these 5 steps, now why I put these 5 steps is, out of these 5 steps, what is important in terms of your examination is mainly step number 5, right? As well as up to an extent even step number 3, right? So because of that, we'll look at these 2 steps in detail, and thereafter let's go to the real annual reports and discuss about the revenue recognition. So the first thing is, I'll discuss about step number 5. Now at the inception of any contract, you have to determine how you are going to recognize the revenue, whether it is over time or point in time. Now if it is satisfied, if the particular performance obligation is satisfied over time, right, then what do you mean by over time? Over the period. If it is over time, you have to recognize the revenue based on the progress towards the completion of the performance obligation. You have to measure what percentage of the performance obligation is completed. Now in the standard, to measure the progress towards the completion, right, to measure the, I'll come here, right, to measure the progress towards the completion, there are 2 methods given, input methods and the output method. Why I'm reminding these things is, once you go through the annual reports, you will see these wordings, right? So because of that, before going through the annual reports, I'm actually explaining, thereafter we'll go into the annual reports straight away. So what I was telling, so to recognize the revenue, step number 5, there are 2 approaches, over time and point in time. If it is over time, if it is over time, you have to measure the progress towards the completion. To measure the progress towards the completion, there are 2 approaches, input method and the output method. What do you mean by input method? Input method means seller's effort. Now in a particular transaction, there's a seller and buyer, no? Service provider and the customer, in this case hospital and the patient. So the seller's effort mean, right, seller's effort mean to complete the particular performance obligation, how much of an effort that the seller has taken. So here the normal approach is cost approach. Cost approach means what? Cost incurred to date, you divide by the total estimated cost, right? Cost incurred to date divided by the total estimated cost. That is input method. Output method mean you look at the value of the particular performance obligation to the customer. So in case of the output method, there are normally 2 approaches. One is survey of work performance. You can do a survey and find out how much of work have been completed. Normally, if you look at the construction industry, when you construct a building, You can do a survey and find out, okay, this much of percentage is completed, right? But in a hospital, is it possible is the question. So there's another output method called time elapsed. So out of the total time period, how much of time is now elapsed? So input method, output methods. Out of that, you have to select what is the method that you are going to use to measure the progress towards the completion. Okay, right. Then my question to you is, how do you decide? Now I told you in this revenue recognition model there are 5 steps involved, and out of these 5 steps, I believe that if it is tested in the examination, what is most important is the step number 5. In step number 5, you have recognized the revenue once the performance obligations are fulfilled, and there are 2 ways of recognizing the revenue: over time and point in time. So how do you decide whether it is over time or point in time? What the standard says is there are 3 criteria. There are 3 criteria. Out of these 3 criteria, at least if one criteria is met, it has to be recognized over time, over the period. No need to satisfy all 3, right? Just satisfaction of one criteria is enough out of these 3, right? So if none of these 3 criteria are satisfied, it's automatically falling into point in time. If one of these 3 criteria are satisfied over time, if none of these 3 criteria are satisfied, then it is point in time. Actually, in terms of this particular question, hospital or the healthcare service, out of these 3 criteria, what is satisfied is, or what is relevant is the first one. That is, customer is receiving and consuming the benefit of the seller's performance simultaneously as seller performs. Seller performs and customer consumes the service or the performance obligation simultaneously. Now let's say when you are under medical treatment, hospital is providing the service, and as the patient you are consuming the service simultaneously, right? Then and there, like lecturing. Now I am delivering a lecture. You are consuming the benefit or the service simultaneously, right? Similarly, in terms of hospital healthcare service also, seller perform and customer consume the service simultaneously, so that what will happen is most of the time, right? I'm using the word. So the revenue has to be recognized by using the overtime approach. But there are instances where we look at, there are instances where revenue to be recognized by using the point in time approach as well. So these 2 are not that applicable. I'm not going to, as I said, I'm not going to teach you SLFRS 15, right? If you don't know SLFRS 15, or if you are not thorough, you must go through your notes or videos or whatever. Be 100% comfortable with the standard, because this is going to be most of the time, or as I mentioned, that it's probable that it's going to be tested in your examination. So the other 2 points are not that important in terms of this particular matter, which you can go through later on. What is important is the first one, right? Let's say if the first one is satisfied, that means what? Revenue has to be recognized over the period of time, right? If first, second and the third one, or none of these things are satisfied, it is point in time. So I explained if it is recognized over the period of time, how to measure the progress towards the completion, input methods and the output methods I have explained. Then I told you, if the performance obligation is not satisfied over time, that means none of the 3 criteria is satisfied, it has to be recognized at a particular point in time. What do you mean by at a particular point in time? The point where the control is passed. Okay, you have to decide what is the particular point at which the control is passed. Now in the standard, right, so there are a number of indicators given for you to see that what is the point at which the control is passed. So there are actually 5 guidelines are given. So I'm not going to go through it again. Now for example, let's say you can say you have to look at what is happening to the legal title of the good, whether the legal title has been transferred from seller to the buyer, whether the risk and rewards have been transferred from seller to the buyer, whether seller has a right to collect the payment, whether customer has accepted the asset, and whether the physical possession of the item have been transferred to the customer. So these are the 5 items. So even though I said that I'm not going to go through, I actually read all these 5. So these are the indicators. By looking at these indicators, you have to decide whether the control is passed or not. Best example is in terms of a hospital. Think about a pharmacy. So when you have a pharmacy, it's what? Sale of medicine. In terms of the sale of medicine, what is the revenue recognition approach? Whether it is point in time or over time. It is point in time, right? So if it is point in time, because none of the 3 criteria, what is mentioned over here, are satisfied in terms of the pharmacy operation. So that you can recognize over the period of time. If it is not over the period of time, point in time means once the control is passed. So at the time where you satisfy these criteria, you should recognize the revenue. Right, okay, so now you know the theory. Now we start the real work. What is the real work? Practical examples. That is the best way to learn, right? Practical examples of the annual report of the companies. So as I mentioned, so when I was preparing to the lecture, I was going through 4 annual reports, right? One is this CASri group, then Durden's, Navaloka, as well as one more, Lanka hospitals. So these are my 4 references. Out of that, actually, information about the 3 company annual reports I have included into the presentation. Now your job is easy, right? So otherwise you need to go through the annual reports. No, I went through and included the important sections into the PowerPoint presentation itself. Right, okay. Now what we discuss is that whether they have correctly put into the annual reports. Carefully read. Na? So if I am the examiner, if the examiner is rational, I am not the examiner, no. If the examiner is rational, examiner is definitely going to test SLFRS 15 in your paper, because as I mentioned, if it's a hospital, critical aspect is the revenue recognition. That's why in each and every hospital, it is the first key audit matter. Okay, right. Under SLFRS 15, group determines at contract inception whether it satisfies the performance obligation over time or at a particular point in time. Isn't it what we discussed? At the inception of any contract, you have to see that whether the performance obligation is satisfied over time or point in time. For each performance obligation satisfied over time, if the performance obligation is satisfied over time, group recognize the revenue over time by measuring the what? Progress towards the completion. So if it is over time, you have to measure the progress towards the completion of the particular performance obligation. So what we discussed, right? So the previous slides is the theory. Now we are looking at the application. Revenue from here, moving into the different streams of revenue. I informed you, or I told you about the pharmacy. So revenue from sale of pharmaceutical items. Now with regard to pharmaceutical items, now you see, now you have to decide whether it is point in time or over time. Whether these 3 criteria are satisfied. No, that's not going to be satisfied. So if you look at, because the second and third one is not relevant in this situation. If you look at the first one in terms of the pharmaceutical items, let's say there's a pharmacy in the hospital. Can you say that seller is performing and the consumer is consuming simultaneously? No, that's not happening. No. If that is the case, so at the time of you issuing itself, patient has to consume all the pharmaceutical items. That's not happening, no. Right? So because of that, the first criteria is not going to be met. So if it is not met, if all these 3 items are not going to be met, it's not over time, it is at a particular point in time. Point in time means once the control is transferred. Okay? Right. Revenue from sale of pharmaceutical items are recognized at a point in time when the control of those items are transferred to the customer. right? Point in time when the control of these items are transferred to the customer. Is that clear? Right, okay. Now you know one performance obligation in hospitals is sale of pharmaceuticals by the pharmacy. That's going to be satisfied at a particular point in time. Point in time means once the control is passed. To decide whether the control is passed or not, there are 5 indicators. Okay, risk and rewards, physical possession. Okay, seller has the right to collect the payment. Whether the customer has accepted the asset or accepted the goods. So likewise, there are 5 things that we already looked at. Right, now the next performance obligation. Revenue from outpatients are recognized at the point in time when the services are rendered. So what does that mean? Now let's say you want to channel a consultant, right? So you don't want to be getting admitted to the hospital. You go and get the service and come back. So what is the point at which the performance obligation is satisfied? Once the consultant renders the service to that particular customer. At that time you recognize the revenue. Revenue from outpatients are recognized at the point in time when the service is rendered. So you know about that as well, that aspect as well. Okay, that particular point you recognize the revenue when the service is rendered. Next one, inpatient. Revenue from inpatients are recognized. So let's say if you are admitted to the hospital, so there are medical treatments, ongoing medical treatments. So the revenue from inpatients are recognized over time. Over time means what? Because why? In that case, hospital provide the service and the patient is consuming the service simultaneously. So the revenue has to be recognized what? Over the period of time. Over the period. If it is over the period, we know we have to measure the progress towards the completion. Now I am asking a question from you. Right? I am asking a question from you. If it is a progress towards the completion, if you need to measure the progress towards the completion, I told you the standard gives you input methods and the output methods. Now rationally think. Am I going to use input methods or am I going to use output methods? That's a judgment. Huh? Okay, that's a judgment to be, because standard allows you the choice, input or output method. Whatever the best, explain the progress towards the completion, and once you select the method, it has to be used for similar performance obligations. Okay, so what do you do? So are you going to use the input methods or output methods? Okay, think about the output methods. Can I use the output method? Now think about a patient who is getting the treatment in hospitals. A patient is admitted, right? So what are the output methods? What are the output methods? Survey of performance. Can you go to the patient and ask that, okay, out of your treatments, what percentage is completed? Can you ask that? Difficult, right? Can a patient say that, okay, 60% I am recovered? Difficult. So you can't measure the survey, or you can't do a survey and find out how much of performance obligation is fulfilled, right? I'm not telling, like some hospitals might say that, okay, out of the treatment we have completed 60%, but it's a little difficult. Then time elapsed. Sometimes when you are admitted to an hospital, you don't know how much of time it would take for the treatment. Maybe 7 days, 1 month, 3 months, you don't know. So that is also a bit difficult. So because of that, most of the times hospitals are using input approach, that is seller's effort, cost incurred as a proportion of the total cost. Now for each service, you know that you are incurring the cost, right? When you incur the cost, you know the profit margin and you recognize the revenue relevant to that cost. right? So even in Asiri Group, we look at the annual report in a little while. So they use the input method to measure the progress towards the completion. Okay, that was clearly mentioned, specifically mentioned in the annual report, right? If you go through, I hope you understood, right? Right, that's why I explained the theory first. Now I can go into detail and look at practically how it is happened or how it is happening. The group assesses its revenue arrangements against the specific criteria. Okay, what it says is, if I read from here, revenue from inpatients are recognized over time by measuring the progress towards the complete satisfaction of the performance obligation. Okay, not mention the method, no. Then the group assesses its revenue arrangement against the specific criteria in order to determine if it is acting. Okay, the next thing is, okay, not in the Asiri group, but I can remember in somewhere in this PowerPoint presentation, some other hospital, maybe Lanka hospital, we'll look at that, right? So it is mentioned that they are using the input method, but here it's not mentioned the method that the hospital is using to measure the progress towards the completion. It just mentioned that inpatient healthcare service, you recognize the revenue over the period of time and you measure the progress towards the completion. Not mentioned whether it is input or output, right? Probably in Lanka hospital it's mentioned, right? Once you go through the particular same area in terms of Lanka hospital, we'll look at, okay? Right. Okay, coming to the next one. What is that? I told you another complexity in terms of the hospital's eyes. You need to decide whether you are the principal or agent, because recognition of revenue is depending on, it is different. If you are the principal, you recognize the gross amount as the revenue. But if you are the agent, you recognize the net amount only. So how do you decide that whether you are the principal or the agent? Principal means what? You act. You have the primary obligation of providing the service. Right? Agent means what? You act on behalf of someone else. Now in terms of the consultancy fees, I told you, in terms of the doctors, think about your real life, right? You want to meet a consultant. So you are looking the hospital, or you want to go for a particular consultant. You want to go and meet a particular consultant, right? So somebody recommends, let's say your friend or relative recommend, okay, this doctor is good. You want to meet that doctor. Then you look at, okay, in which hospital that particular doctor is available. Then you book that, right? In that case, think about who decides the price. Can hospital say that all the consultants, it is only 4,000 rupees? No, hospital doesn't have that say, right? Even the pricing is decided by the consultant. Hospital doesn't have the right to decide the price. That is also because now if a consultant is famous, he would charge, let's say, 6,000. Another one would be charging 2,000. Depends, right? And the time where the consultant is available is also decided by the consultant, right? Hospital can't say that, okay, particular consultant, come at 4 o'clock, come at 2 o'clock. You can't say like that. So the point what I wanted to mention is, in terms of, now we are looking at the accounting from the hospital's perspective, right? So hospital's perspective, this doctor channeling, hospital doesn't have the primary responsibility of providing the service. Actually, patient is expecting the job to be done by the consultant, not by the hospital. Because hospital doesn't have any control over pricing, the time, nothing. So in that case, tell me, hospital should be the principal or hospital should be the agent? What do you say? Principal or agent? Let's see whether you understood. Then only we can move forward. Agent, right? Yes. So now look at the example that I have given. Now let's say you pay 5,000 rupees to channel a particular consultant. Out of that, consultant charge is 4,000 and the hospital fee is 1,000. Let's say always 20% goes to the hospital. 5,000 into 20%, 1,000 remainder to the consultant, 4,000. Now tell me, if you are the accountant of hospital, how do we put the double entry? Now you are the agent, no? But patient make the payment to the hospital, let's say. Now don't think about e-channeling, then you have a payment to that particular e-channeling company as well. Forget about that for the moment. It's getting complicated otherwise. So think about, okay, patient is making a payment of 5,000 rupees. Out of that, 20% goes to the hospital, which is 1,000 rupees, and remaining 4,000 you have to pay to the doctor. You are the accountant of the hospital. What are the double entries that you are going to pass? I'll tell you the debit entry, right? Debit cash 5,000. Right? Debit cash 5,000. Where to credit? What is your revenue? What is your revenue? Revenue credit, how much? Hurry up. Revenue credit 1,000. Correct. Then remaining 4,000 to be credited to the payable to that particular consultant. It's a liability. So basically, when you are the agent, what is your revenue? Net basis. What is the net basis means? Your revenue is only 1,000. Remaining 4,000, it's a liability payable to the consultant. Okay, so now it is tested in the examination. You are fully thorough with that. I hope you understood. Okay, done. So that is this para says. The group assesses its revenue arrangements against the specific criteria in order to determine whether it is acting as the principal or the agent. Group has concluded that service revenues are presented net of doctor fee. Now out of that 5,000, you deduct the doctor fee 4,000. What is your revenue is 1,000 net of doctor fee in cases where group is not the primary obligator and does not have the pricing latitude. So you are not the primary obligator, or else you don't have the power to set the prices. It is all depending on the consultant, right? You are working on behalf of that particular consultant. You are the agent, right? Okay, clear. I hope you understood now. These are very important aspects. Right, now go to the next annual report. Okay, referring to one annual report is not enough. That's why I referred 4. Right, that's why I said that your job is now easy. Right, you can focus on the presentation without referring to all these annual reports of the hospitals. Right. What is next? Lanka Hospital. Right. So which is a 31st December end company. Annual report for the year ended 31st December 2024. Right. So straight away, let's move to the, so these are the sections. Let's go through. I'm taking a bit of time here because these are the most important aspect. Okay. So the other areas of the standard, other areas of the preceding analysis in terms of the accounting standards, we can quickly go through. But here I need to spend time. Right. The group is in the business of providing healthcare and laboratory services. Exactly the same what we have in this particular scenario. Right. This is Lanka Hospitals. Revenue from contracts with customers is recognized again when the control of the goods and the services are transferred to the customer at an amount that reflect the consideration to which group expected to be entitled in exchange for those goods and services. Right. Then the group has generally concluded that it is the principal in its revenue arrangements except for the agency services explained below in 4.15.1b. We'll look at that, right? So this is the particular area. Again, what? Consultancy fees. Right? What it says, carefully read. Group has generally concluded that it is the principal. We are the principal, right? Except for the agency services as explained in 4.15.1b. So what it says is generally we are the principal except what is mentioned under this particular point. That is yet again the consultancy fee what we have already explained. In all other cases you are the principal. That's correct. Okay. in terms of this particular matter, right? There can be other situations which we'll look at in detail. In terms of this particular matter, this particular company, this is their conclusion. Because it typically controls the goods and the services before transferring them to the customer. So why you are the principal? Because you have the control over the goods and the services before you transfer that to the customer. So if you are the principal, you should have the control over the goods and the services before you transfer those goods and the services to the customer. Right. Then the disclosure of significant accounting judgments, estimates, assumptions relating to revenue from contracts with customers are provided below. Right. Hospital revenue. Okay. Group recognizes revenue from hospital services over time. Okay. Revenue is recognized what? Over time using, okay, this is what I mentioned. Input method. Okay. Out of the total cost, what percentage of cost that you incurred. So that out, so in that way you measure the progress towards the completion. Right. So group recognize the revenue from hospital services over time by using the what? Input method to measure the progress towards the completion. That is the satisfaction of service, because the customer, see now here, why you say that it is over time? Customer simultaneously receive and consumes the benefit provided by the group. So the theory what we explained, right? First of all, why we recognize the revenue over the period of time in most of the cases? Because hospital provide the service and customer consume the service simultaneously. If it is over time, the first criteria out of the three criteria what I mentioned is met, so that it is over time. If it is over time, you have to measure the progress towards the completion. To measure the progress towards the completion, you have input methods and the output method. In this case, Lanka Hospitals is using the what? Input method. Crystal clear, right? Then there's an exception in terms of the revenue recognition, because except for this particular situation, in all other cases, they say that Lanka Hospital consider itself as the principal, but here it is not the principal but the agent. What is that? Same what we have discussed in terms of the previous one, Asiri Group, consultancy fee, right? Consultancy fee collected on behalf of the in-house and visiting consultants by the group. It can be consultancy fees collected on behalf of the in-house and visiting consultants by the group do not form part of the revenue, are excluded from the revenue. This is what I mentioned. Right? Now in the previous example, you collect 5,000, but you exclude the consultant's fee. 4,000 you exclude. It's not your revenue. Your revenue was limited to 1,000. That is the same thing what is discussed over here. Okay? I hope you understood. Moving on. So then they justify why now in terms of the consultancy fee, why you consider hospital as the agent. You justify. What is that? Company act as the agent for rendering the healthcare consultancy services to its customer due to following reasons. But I already explained these things. Because why? Primary responsibility to provide the consultation service to the customer or fulfilling the order rests with the particular consultant. In terms of the consultancy fees, 4,000 rupees, why you are not recognizing as your revenue? Because who has the primary obligation to provide the service? Not the hospital, but to the particular consultant. So I am the accountant of the hospital, so that it's not my primary responsibility, so that I am not the principal, I am the agent. Then I told you the setting the prices. I can't decide what is the price. Consultant decide, okay, it is 4,000, that he need 4,000. I can't set that. So that is the other reason why you consider hospital as the agent. Establishing the consultancy charges and other terms of the service transaction rest with the what? Respective consultant. Establishing the consultancy charges and the other terms, at what time that the patient has to come, all these things are decided by the respective consultant. So that hospital is not the principal, hospital is the agent. Clear? Right. Then next one, now we discuss about part of or some of the performance obligation. One more, what is that? Pharmacy. Pharmacy we discuss, same as RCR group. Actually in all the hospitals, always pharmacy revenue you recognize at a particular point in time. Revenue from sale of goods is recognized at the point in time when the control of the asset transferred to the customer. Generally on delivery of, here it's mentioned as equipment, but it's not equipment only, it can be medicine, it can be equipment, it can be devices. So in a pharmacy you sell number of things, right? So revenue is recognized at a particular point in time once the control is passed, right? Because in case of the pharmacy you can't say that seller is performing and consumer is consuming simultaneously, no, right? So because of that, it is satisfied at a particular point in time. Point in time means once the control is transferred. Right. Right, so I told you, if I go back to the theory discussion, I told you in this particular reason, if SLFRS 15 is going to be tested. So the most critical aspect is the step number 5, whether it is overtime or point in time performance obligations, and also we discuss about the principal and agency relationship, right? So in addition to that, so this one, step number 3, I told you, because when I go through the annual report, especially in Lanka hospitals, I figure it out, examiner can construct a question from step number 3 as well. He can easily give you a good question. I actually realized that not when I was going through the pre-scene, but when I was going through the annual report, especially Lanka hospital, I figured it out there. That is determining the transaction price, right? In terms of the determination of transaction price, right? So there are subtopics. If you can remember, if you study properly, you should now remember. So when you are determining the transaction price, there are 4 subtopics that we discussed, or particular lecturer should have discussed with you, right? What are these 4 things under the transaction? Determining the transaction price means what? Normally the consideration that you collect from the customer, right? You identify the contract, identify the performance obligation, then what is the transaction price? Determination of the transaction price. Under this step, right, you should have discussed, something called variable consideration. Have you discussed? You should have discussed significant financing component. You should have discussed. Oh, it is there in your keyword, but you can't remember. What else? Non-cash consideration. How to determine the transaction price if the consideration is non-cash. One more. Consideration payable to customer. Normally customer pay the consideration to the seller. What if seller also pay a consideration to the customer? Have we discussed or not? So who can remember these 4 areas at least now? Remember? Variable consideration, significant financing component, then non-cash consideration, after that consideration payable to customer. Right? If you can't remember, you must study these areas, because SLFRS 15 is regularly tested. It is critical in this particular situation because of this pre-scene, right? Out of that, in terms of this particular scenario, what do you think that it would be important in terms of this particular business? I don't think that they would test non-cash consideration, right? Similarly, I don't think that there are situations where consideration payable to the customer would also be tested. What can be tested is, by looking at the business, variable consideration and the significant financing component. Out of that two even, variable consideration. What do you mean by variable consideration? Variable consideration is involved. Okay, there are number of ways where the variable consideration can get involved, but in terms of this particular matter, how it can be get involved is variable consideration. Let's say pharmacy can sell, I told you pharmacy would sell different things. It can be medicine, it can be devices, it can be equipment. Let's say when pharmacy is selling equipment or the devices, it gives a chance to the customer, if the product is not meeting the expectation, customer has the right to return the equipment or the devices back within 2 weeks time. Let's assume. In that case, my question to you is, can you, now you are selling a particular equipment, you know at the time of sale itself, if customer is not happy, he can return this. My question to you is, can you recognize the revenue at the time of sale of the equipment? Because we now identified that in terms of the pharmacy, revenue to be recognized at a particular point in time, once the control is passed. Now my question is, can you say that the control is passed at the time of sale in a situation where customer has right to return the goods within 2 weeks? What do you say? Yes or no? What did we do? Have we discussed questions of this nature? So your lecturer should have discussed the questions on this nature. So this is where this particular topic, what is the technical name? Why is the technical name? You are selling goods with a right to return. What's the technical name in SLFRS 15? Refund liability. Do you remember? Refund liability. What is that? What do you do here is, everything what you sell won't get returned. No. It is really actually it's getting returned. So you look at your past pattern and look at, okay, how much of items are normally getting returned. So when you look at that, it is, let's say 1% of the items what you sell is getting returned. So what you do is, let's say you have done or you have completed selling, or you have raised invoices for items which is worth of, let's say 100 million during the month. 100 million is the total value of sale of equipment, devices and medicine, everything. So especially these devices and equipment, right, you sold. Now you have the customer has 2 weeks time to return. In that case, are you waiting for 2 weeks time to recognize the revenue? No. You recognize the revenue, but out of that 1%, how much is, because you look at the past returns and you identified past return percentage is 1%. Then out of this 100 million, what you do is 99 million you recognize as the revenue, and 1 million you keep in a refund liability account. You don't take that into the revenue. Or else you can pass the entries like this. You are experts in double entries, no? So what's the double entry? Debit cash first double entry, debit cash 100 million. You receive 100 million. Let's assume you receive cash then and there. Debit cash or debtors 100 million. Credit revenue 100 million. You have done that. Then out of that 1 million you need to take out. You debit revenue 1 million, credit refund liability account 1 million. Ultimately, if you look at the net impact, how the entry is passed, you debit, let's assume you receive cash, cash debit 100 million, revenue credit how much? 100 minus 1, no? Because refund liability amount You debit revenue and credit refund liability. So revenue is how much? 99. And refund liability. 1. Okay. So this is a variable consideration. Why variable consideration? What is the technical aspect? What is mentioned in the standard? If you have variable consideration is involved in determining the transaction price, you can take the variable consideration into the transaction price if you believe that significant revenue reversal will not occur. That's why I said that you know that entire 100 is not getting returned. There won't be a significant reversal of revenue. So because of that, what you do is you estimate how much it can be returned and you make kept a refund liability for that amount, but the remaining amount you recognize as revenue. Are we clear? Right. Then after recognizing the, when you recognize the refund liability, what else it comes to your mind? Now you sold goods with right to return. Another topic where you should have studied. Right? Another topic where you should have studied. Now on one side you have a refund liability account, that's a credit account. Now let's say customers have returned these goods back to you. So there's a value, right? So what you do is when you create a refund liability, on the other hand, you have to identify what is the cost of these returns. Now the selling price is including the margin. No? What is the cost? Let's say you keep a 20% margin. If 20% margin is kept on this 1 million, let's say if you get returns worth of 1 million, 20% margin means 0.2. Then what is the cost? 0.8 million. That 0.8 million you recognize as an asset, provided you can take these goods and sell back to another customer. So when you recognize the refund liability, you also recognize the right of recover asset. That is the cost of the items which are getting returned back. So in my example, what is the cost? 0.8 million. So the double entry, what is the double entry? You debit what? Right to recover asset. Debit. Let's say 0.8 million. Okay. Where to credit? Cost of sales credit. Because when you were now at the time of recognizing the revenue, you should have charged the cost to the cost of sales. No? When you recognize the revenue, you should have charged the cost to the cost of sales. Now when you recognize the right to recover asset, your cost of sales will come down by that amount. So the right to recover asset, debit 0.8, cost of sales, credit 0.8. So the revenue will be reduced by 1 million because of the refund liability. Cost of sales will be reduced by 0.8 because of the right to recover asset. Again, I can't spend more time than this because these are pure theory topics you should have discussed and you should have studied. If not, go and refer your tutors, watch the videos and revise your knowledge. I hope you understood, right? So this is actually what step number 3. Determining the transaction price. One area is variable consideration is involved. Okay. What else? What else can be tested in terms of the step number 3? What else? Significant financing component. What do you mean by significant financing component? Forget about this hospital. First of all, let's say you sell something to a customer. Okay. Right. And customer is given time to pay you 2 years time. Okay. When you set the consideration, you definitely consider the financing component, right? Let's say you sell something today and you ask customer to pay you after 2 years, let's say 100,000 rupees. Within that 100,000, actually you have entered into 2 transactions, no? There's a sale component as well as the financing component. you have to separate these two elements. So how do you do that? You take what is the present value of that 100,000 rupees. Assuming the discounting rate of 10%, let's assume the discounting rate is 10%. Okay. In that case, you discount this 100,000 for 2 years at 10%. Then you get 82,600. Okay. So let's assume you get 82,600. So your revenue is how much? Now when you sell the good today to the customer, you don't receive any cash today. You receive cash after 2 years, but still you have to book the revenue, no? Because you transfer the control of the good to the customer. Now, how do you book the revenue? You fair value. That means you discount it. You calculate the present value. Let's assume 82,600. What's the double entry? Debit, receivable. You didn't receive cash. Credit where? Revenue. Then the receivable amount you need to unwind over the next 2 years and recognize the what? Finance income. So that's why I said that there you have sale of goods as well as the financing component. So the point what I wanted to mention is, when there's a gap between you provide the performance obligation and the cash collection, so always there can be a financing component involved. Right? It can be other way around as well. What is that? You receive cash today, but you provide the goods after 2 years. So in that case, who got the financing benefit? Customer or you? In the previous example, customer got the financing component. Customer got the benefit. Here, seller is getting the benefit because you receive the cash today, right? But you provide the goods after 2 years. It's the other way. Okay, significant financing component is involved. Again, I don't have time to explain how to do that, the accounting and all that, so I hope you understood. Now think about an hospital. Is it happening? Consultancy fee, let's assume. Or some other services. So sometimes you make the payment to the hospitals in advance, no? And hospital provide the service later, maybe after a week. Right? Hospital collect cash now and provide the service after a week. What is that? So similar to the example what I have mentioned, but the time gap is only 1 week. So the question that you need to answer is whether it is significant, whether the financing component is significant. The examples, 2 examples what I have given is 2 years gap. It is significant. But in this particular example, 1 week or 5 days, is it significant? It's not significant. So because of that, standard allows, so it is called as there's a practical expedient, saying that if the gap is 1 year or less, you can forget about the financing. So most of the times in terms of the hospital, it is within 1 year or less. There's no gap more than a year normally. So because of that, even though this financing component is there, it's not significant. So that you can get the benefit of this practical expedient given or the relaxation given in the standard and forget about the financing component, but you should be aware. Right? Is that clear? Right. So that's why I said that when I'm discussing, I'm going into detail and discussing, right? This is the maximum possible where examiner can test, right? So he might not go up to these areas, but the maximum possible that you should be aware, and that is how you should get ready for the examination. Whatever it is asked by the examiner, we are ready. Right, okay. So the step number 3. So we are reading the annual reports. Okay. The group, I'm back to read the annual report of Lanka hospitals, right? So the group considers whether there are other promises in the contract that are separate performance obligation to which portion of the transaction price needs to be allocated. Pure theory. I told you, once you decide the transaction price, you need to allocate to the performance obligations. That is step number 4. In determining the transaction price, what is that step? Step number 3. Step number 3 is to determining the transaction price. For sale of goods, group considers the effect of what? Variable consideration and the existence of significant financing component. Okay? Right. Variable consideration. Variable consideration. Okay, let me ask a question before we read. This is how you can assess yourself for the readiness for the examination. If you can answer to the questions which I raised, you are ready. Otherwise, you have to work hard. I am not telling that you are not ready, you have to work hard. Now, when I was discussing about the variable considerations in terms of this establishment of the value of the refund liability or the calculation of the variable consideration that you can take into the revenue. So how much we took into the revenue? 99. No? If I go back, the entry that I have passed is cash debit 100 and you credit 99. 99 means what? This is the variable consideration. What I believe, there won't be any significant reversal. Okay, but one can be reversed. That's why I have not taken one and I decided that is 99. What I'm asking is, how to decide this variable consideration? Whether it is 99 or 95 or 98. What are the approaches given in the standard to decide the variable consideration? There are two methods given in the standard to decide the variable consideration. Who can remember? What are these two methods? What are these two methods given in the standard? Most likely outcome, and the other one, expected value. Right? You are given two approaches to decide the transaction price in terms of a variable consideration. Expected value and most likely outcome. Okay? So, expected value means you look at the probabilities and outcomes and the associated probabilities and multiply and get that this is the expected value. Most likely outcome means you look at the outcomes, number of outcomes, out of that you select the outcome with the highest probability. Most likely outcome means you have outcomes, you select the outcome with the highest probability. So yet again go through, right? So based on, it's not mentioned, so might have been it's mentioned in the annual report, we'll look at. So to decide this transaction price, whether they have gone through the expected value approach or the most likely outcome approach. So let's see, right? Variable consideration. If the consideration in a contract include variable amount, the group estimates the amount of the consideration which it will be entitled in exchange for transferring the goods to the customer. Variable consideration is estimated at the contract inception and constrained until it's highly probable that significant revenue reversal in the amount of the cumulative revenue recognized will not occur when the associated uncertainty with the variable consideration is subsequently resolved. Some contracts for the sale of goods provide customer with a right to return. So basically, entire theory, what it says is when there's a variable consideration is involved, to take that into the transaction price, what is the condition to be made? You have to be pretty sure that once you take this variable consideration into the transaction price, there won't be a significant cumulative revenue reversal. Okay, so a significant revenue reversal will not occur. So that's how we have taken that 99 into the revenue. There's a variable consideration. What is the variable consideration? Because of the right to return. Customer has the right to return. Now, before you take that into the revenue, before you take that into the transaction price, you have to ensure that as I am recognizing this 99, there won't be a significant revenue reversal in the future. So based on that premise or based on that assumption, based on that judgment, I have taken the, I have recognized the revenue which is in my example worth of 99. Right. Okay. Right of return gives rise to variable consideration. Right. This is what I mentioned. So I was discussing the step number 3, that is to decide the transaction price. One aspect of deciding the transaction price is the variable consideration. Why there's a variable consideration involved? Because of the right to return. So when there's a right to return, it's a variable consideration that has to be factored when deciding the transaction price. Right to return certain contracts provide a customer with a right to return to the goods within a specified period. In my example, I told you hospital is selling equipment where a customer can return that within 2 weeks' time. The group uses, this is the point, expected value method. I told you when you are deciding the variable consideration, you have two approaches, expected value approach and the other one is most likely outcome approach. So in this case, Lanka Hospital, to decide the variable consideration where the right to return is involved, hospital has used the expected value method to estimate the goods that will not be returned, because this method best predicts the amount of the variable consideration to which group will be entitled. Okay, go through again. The requirements in SLFRS 15 on constraining estimates of variable consideration are also applied in order to determine the amount of the variable consideration that can be included into the transaction price. For goods that are expected to be returned, instead of revenue, group recognizes a what? Refund liability. Now in my example, you take out of 100, 99 into the transaction price, variable consideration, 1 into refund liability, that is the expected returns. Then I told you when you recognize the refund liability, it is not mentioned over here. This is because this is about the revenue recognition. When you recognize the refund liability, the cost of the items that is getting returned, you need to estimate and recognize the right to recover asset. Right to recover asset debit 0.8 million, cost of sales credit 0.8 million. Are we clear? We'll look at the theory part, right? After going through the annual reports, I'll go into the theory and discuss about it. Then significant financing component. So this is also under step number 3, determining the transaction price. Significant financing component. Generally, group receives short-term advances from its customers. I told you, like when you want to get a service, so you may make the payment 1 week before. Now from the hospital's point of view, it is short-term advances. Okay, so the question is whether I should consider this as a item which involves significant financing component. What I told you, if the gap between the time where the consideration is received and the performance obligation is satisfied is 1 year or less, the standard allows you to forget about it. Okay, using the, this is the point, practical expedient in SLFRS 15, group does not adjust the promised amount of the consideration for the effects of the significant financing component. If it expects at contract inception that the period between the transfer of the promised goods or the service to the customer and when the customer pays for the goods or service will be 1 year or less. So because of that, it's simple, right? So as it is less than a year, normally you don't consider the financing component when determining the transaction price. Are we clear? Are we clear? Before I go through these, principal and agent, which we discuss anyway, let me complete this. I told you, in addition to step number 5, here step number 3 is also important. What is step number 3? Determining the transaction price. In the revenue recognition model, step number 3 is determining the transaction price. So under the determining of the transaction price, there are 4 topics which are important. Out of that, in this particular matter, I have discussed about 2 topics. One is variable consideration. I already explained this one. You can take the variable consideration into the transaction price when you see that there won't be a revenue reversal in the future. right? There won't be a significant cumulative revenue reversal in the future. In that case, you can take the variable consideration of the transaction price. Then when you are estimating the value of the variable consideration, I told you there are two methods which are allowed in the standard: expected value method, and the other one is most likely outcome method, right? Out of these two methods, you had a situation of selling the goods with right to return, variable consideration. So you have to estimate the value of the variable consideration. First of all, you have to decide whether you are going to take the variable consideration into the transaction price or not. Now you decided you are going to take it, because why? There won't be a significant revenue reversal. On that judgment, I decided, yes, I am going to take the variable consideration into the transaction price. Then how am I going to estimate the variable consideration? Two methods: expected value method and the most likely outcome method. So you should have discussed examples in terms of both these two methods. I explained that. If you can't remember again, go back and refer the tunes. So expected value method and the most likely outcome method. Out of these two, what Lanka Hospital has selected is expected value method. I already explained this one. When you sell goods with right to return, why I have included these slides is because for the students who doesn't know, at least to refer this handout and understand these things, right? So right to return, I explained this, right? So you need to recognize the refund liability for the goods that you are expecting to be returned. You expect, in my example, 1% to be returned. That means 99% to recognize as revenue, transaction price, 1% to be returned. That 1% you have to take into the refund liability. Then the cost of these goods that you are getting returned, right, that is the selling price minus the profit margin. So the cost you need to recognize as an asset, right to recover asset, and that amount has to be deducted from the cost of sales, which I have already explained. Okay. Then this one, the last point under the revenue recognition. Before I go to the key audit matters, okay, I'll quickly, after discussing this, I'll show you, because the things what I have explained is up to now in terms of the annual reports I have taken from the accounting policy notes, right? Then at the very beginning I told you why the revenue recognition is important, because in all hospitals the first key audit matter in the audit report is the what? Revenue. So that's why we spend this much of time on this. Okay, because this time in the pre-scene, out of the accounting standard, if it is tested, there are less areas to test. Okay, so this is the most probable, highly probable area, revenue recognition. Principal and agent we already discussed in terms of the consultancy fee, right? So at the beginning of the contract, you have to decide whether you are the principal or the agent. Principal means you work on behalf of yourself, right? You provide the service. You have the primary obligation to provide the goods or the service, right? Agent means you work on behalf of another person. You work on behalf of a principal. If you are the principal, you have recognized the revenue on gross basis. If you are the agent, you have recognized the revenue on net basis. I told you in consultancy fee, the hospital is the agent, so that you recognize the revenue after deducting the consultancy fee. What is to be paid to the doctor, it's not your revenue. Your revenue is only, in my example, out of 5,000 rupees, consultant is getting 4,000, you are getting only 1,000, right? Let's assume 20% out of the total, 5,000 in 20%, 1,000. Your revenue, what you recognize as the revenue, is only 1,000, because you are the agent. In all other performance obligations we discussed, it can be inpatient, outpatient, laboratory services, issuing, like in pharmacy you issue medicine. In all other services you are the principal, what we discussed. So in that case you recognize the revenue on gross basis, right? And also in the pre-scene, you remember about collection centers in terms of the laboratory services. So these hospital, right? So if even though they have 3 hospitals as well as one company for the laboratory service, they have collection centers in different parts of the country. So in terms of the collection centers, what they are entitled is 10% of the collection fee. Now, if you are preparing the accounts from the collection center's point of view, what do you say? The collection center is a principal or an agent? Now you should be able to answer. By taking the things what we discussed up to now, tell me, so the collection centers to be considered as the principal or the agent? Does it have the primary responsibility of providing the service? No. Basically what collection centers does, you get the business, right? And so these are sample collection centers. You get the sample and that sample is sent to the hospital in Colombo. Then Colombo hospital is doing the testing, okay, generate the report and send it back to the collection center, sample collection centers. Then sample collection center hand over that report to the customer. So if you look at the task that is done by the sample collection center is sample collection and handing over the reports, nothing else. Okay. So if now who has the primary responsibility of providing the service, laboratory service? The hospital. So because of that, now it's mentioned in the pre-scene, they are entitled only for 10% of the total amount collected by the customer. So they are the agent. So let's say if you collect 10,000 from the customer, or let's assume you collect 1,000 from the customer, you collect 1,000 from the customer for a particular testing. So the revenue of the collection center has to be only how much? 100. 1,000 into 10%, 100. Got it? On the other hand, if you prepare the financials or the financial statement of the Colombo hospital, how to account for that? So they have to recognize entire amount collected from the customer as the revenue. Cash debit 1,000, revenue credit 1,000. Then the payment made, 10% commission paid to the sample collection center has to be recognized as an expense. Cash credit, commission expense P&L debit 100. So if you look at the books of the hospital, revenue is 1,000. There's expenditure of 100, commission paid to the sample collection centers. So in that particular situation, hospital is the principal, gross basis. Sample collection center is the agent. Revenue has to be recognized only for the commission, 10%, net basis. But if you look at the other two hospitals, that is in Kandy and Mathura, they provide the full service. Let's say somebody comes and gives a sample to the Kandy hospital, testing is also done in the Kandy hospital. So because of that, Kandy hospital is the collection center as well as the testing is done in the Kandy hospital itself. Right? So because of that, Kandy hospital and Mathura hospital are the principal. They don't need to follow the net basis, but the other collection centers need to follow the net basis when recognizing the revenue. If I go back and show you, what I am explaining is this. The laboratory generates significant revenue and has expanded reach through a network of collection centers located in suburban areas as well as major cities, including Kandy, Mathura, Galle, Gampaha, Kegol, Kalutara and Panadura. For sample collection, only 2 hospitals in Kandy and Mathura are reimbursed for their actual collection cost. So the Kandy and Mathura hospital are getting the full amount. Might have been they are doing the testing in those hospitals itself, not depending on the Colombo hospital. All other collection centers are compensated with a 10% commission on the total value of laboratory test routed through them. I hope you are clear. Okay? Right. Finally, to complete the revenue recognition, these are I mentioned. I have included key audit matters of the latest annual report of Lanka hospitals. So they actually identified 3 key audit matters. Out of that, the first one is the what? Revenue recognition. Okay, see that why they have identified that as a key audit matter. I explained at the very beginning before I start the discussion about the revenue, right? I said that the revenue is important for an hospital, right? Why it is important for a hospital? I told you, pricing formula is complex, volume of transactions are high, IT environment is involved, principal and agency relationship to be looked at. In addition to that, now you know transaction price involve variable consideration, so that it is complex. So that's why it's a key audit matter, because this paper is financial reporting. This is the financial reporting part. There is a section from the risk of material misstatement. Okay, so there's a connection. So, but my discussion is purely for the financial reporting, but I wanted to highlight this point as well, because ultimately it's a one paper, no? Right, so what it says, look at this. Group revenue generated from its healthcare services is disclosed in note number 5 together with the related accounting policy in 4.15, sorry. I considered revenue as a focus area due to complexity of pricing structure, high volume, determination of appropriateness of gross or net basis, principal or agent, of the revenue recognition in certain arrangement, and the reliance on IT control. This is why it is a key audit matter. This is why it is important in terms of your examination as well. Okay, this is the most complex area in the hospital business, right? In addition to that, the second key audit matter identified in Lanka hospital is the inventory valuation, because in the hospital, for again, if I put that particular point as well, in a hospital you have inventory. Why it is a key audit matter? One is certain inventory items are very high value, right? There can be drugs which worth, you know, thousands, sometimes maybe more than 100,000 even, one drug. Okay, then the devices, equipments, so all these things are inventory. You are keeping to give it to the patients, to sell it to the patients, so maybe high value. Then you have to have special storage, you have to keep them under special storage conditions. There can be obsolescence, there can be situations where the net realizable value is less than the cost. Have you done the correct assessment of net realizable value? So the other risky area of the balance sheet of a hospital operation is this inventory. Okay. Valuation of inventory involves judgment and estimate due to the nature of the product. I told you, you have to keep that under special storage conditions, and you have to be careful about the expiry dates. Okay. Nature of the products and stringent quality control requirement. Due to allocation and sale of inventories within the group operations based on the business model, both existence and valuation of inventories are key areas. So if you look at this particular pre-scene, you should have read that by number of times now. So you see there are situations where inventory is not getting correctly updated in the ERP system. You sell inventory, but it's not getting updated in the system. You have to do it manually. So there's a question on the existence of the inventory. So in the system it reflects, but actually it's not there. Then the valuation, net realizable value. Inventory has to be valued, cost to NRV, whichever is lower. Whether that assessment has been done, because these are subject to expiry, subject to special quality control measures, subject to special storage measures, right? Existence and the valuation. So these are the third key audit matter identified by Lanka Hospital is actually about the receivable, right? It is different from hospital to hospital. Revenue is always there, but the second and third one are different. So in this case, it's inventory in Lanka Hospital. And this is actually Dasun's Hospital. So that's the 31st March company for the year ended 31st March 2025. So this is their key audit matter section. What is the first one? Revenue recognition. So first of all, they say that during the year, how much of group revenue and how much of company revenue. Thereafter, it is justified. Why it is a key audit matter? Why revenue is considered as a key audit matter? What it says? Revenue is a key performance indicator, right? Okay. So when is some, now I hope you have discussed about this fraud triangle, right? So the Indunil sir would have covered that in the risk governance and the ethics part when he was discussing the topic. So when you see, now let's say if the management is evaluated based on the key performance indicators, obviously there's a what? Incentive and pressure to manipulate, overstate the revenue. So because of that, so they explained in Dasun's hospital, revenue is a key performance indicator used to evaluate the performance of the group. So always there's a what? Incentive, pressure to manipulate, overstate. So that's why it's a key audit matter. Revenue is a key performance indicator used to evaluate the performance of the group and the company. Given the significance of the total value, number of transactions, high volume, judgment involved in the timing of the recognition, whether it is point in time, over time, variable consideration, significant financing component, judgments, and the reliance on IT. So ERP system, this company has a lot of issues in the ERP system. IT, there are a lot of IT issues, right? So revenue recognition is considered as a key area to focus, right? Okay. And the second key audit matter identified in Dasun's hospital is what? Transaction with the related parties. So even in this group, I thought of discussing this point. So it's a group. 3 hospitals, 1 laboratory, service providing company. There should be number of transactions in between hospitals, right? There can be inventory transfers. If you don't have inventory in Kandy or Mathura, you would have transferred that from Colombo, related party transaction. Then hospital might be referring the laboratory to get the test reports. So there can be payments in between the hospital and the laboratory service providing company. There can be transactions, related party transactions. So here in Dasun's it has been identified. So what it says, related party balances and the disclosure of the group are disclosed in note 15 and 32 in the financial statements. The group is engaged in related party transactions during ordinary course of business, as I have explained. Okay, similar to this group. Considerable part of the revenue, recurring expenditure of the company have taken place through the related parties. Okay, so examiner, so the now SLFRS 15 is done, right? SLFRS 15 is done. We are discussing what? Important areas of the accounting standards that you need to be familiar, that you need to be aware in terms of the pricing, right? So the next area, next standard is LKS 24 because it has been identified as a key audit matter in number of audit reports in hospitals, right? Example is Dasun's hospital as well as some other hospitals. Plus, if you look at this is a group, there can be recurring day-to-day ordinary course of business RPT transactions, related by transactions. So there you need to be aware in the exam in terms of LKS 24. First of all, you should identify who are your related parties. After identifying the related parties, you have to make disclosures about the transactions and the outstanding balances, as well as some other disclosures, whether you have make any provisions for the related parties, whether the transactions are on arm's length basis. If so, that has to be disclosed, right? So there you need to, now you have to identify from the perspective of the reporting entity who are your related parties. Who are your related parties? If I quickly go through, what is mentioned in light blue are related parties. What is mentioned in red are not related parties. Now if you look at the reporting entity, right, reporting entity, your parent entity, it can be an entity, it can be a person. If it is a person, they are close family members, are related parties to you. Then if you have a subsidiary, if you have associate, or if you enter into a joint venture, that particular joint venture is a related party to you. but not the other joint venture investor, right? That means let's assume there's a joint venture, you have 50%, other investor has 50%, you and that joint venture are related parties, but you always you look at from the reporting entity's perspective, you and the other investor are not related parties, right? Then you can be an associate of another investor. Investor has 35% shareholding of this particular reporting entity. That investor can be again an entity, or it can be a person. If it is a person, that person's close family members are related parties to the reporting entity. Then your parent company can have another subsidiary. Now, what is the relationship between you and that subsidiary? You are under the common parent entity. These are sister companies, or you are under common control of the same parent. Parent company, you are a subsidiary and there's another subsidiary. So that subsidiary and you are related parties. Parent company can have an associate. Parent company would have entered into a joint venture. That associate, joint venture and you are related parties. Then coming to people, key management personnel of your entity. What is the definition of a key management personnel? As per case 24, anyone who has the authority and responsibility for planning, directing and controlling the activities of the organization, including all your directors, right? But the key management personnel are not limited to the directors. It can be the senior management team, chief executive officer, chief financial officer, chief operating officer. They are also key management personnel, right? So those key management personnel and their close family members, key management personnel of the reporting entity and their close family members are related parties to you. Again, you are looking at from the reporting entity's perspective. Not only that, now key management personnel of the parent entity. This is the parent entity. Key management personnel of the parent entity and the close family members of the key management personnel of the parent entity are related parties to you. Not only your KMPs, your parents' KMPs. Not only the close family members of the entity's KMPs, close family members of the KMPs of the parent entity are related party to you. If any of these people, it can be your KMP, parent KMP, close family of your KMP, close family of the parent KMP, if any of these people are having a subsidiary, associate or a joint venture, that subsidiary, associate and the joint venture would become what? Your related party. So it's broad, right? It's broad. Are we clear? Right, that's the next area. Now you can go through quickly, right? So SLFRS 15 done, LKS 24 done. What else? What are the other areas? So read this part and tell me what would be the possible area that can be tested in terms of this if it is tested. HPL offered an integrated health service that utilized modern diagnostic tool and advanced medical equipment, most of which had never been used in the country before. That means when you run a hospital, your capital investment is huge because these equipments are highly valued, highly priced. Okay, and also the technology is getting changed. You have to update. Okay. Then company continues to innovate by integrating digital health services, investing in artificial intelligence based diagnostics and pursuing sustainability goals through green hospital initiatives. On the other hand, so the first para is about the PP&E, property plant and equipment. Okay, medical equipment. Second para is mainly towards the what? Intangible assets. You have to invest in a ERP system. You are investing in artificial intelligence, digital technology. So intangible assets. So there can be situations where what? Impairment indicators available. One can be technological obsolescence. The medical equipments, there are internal impairment indicators and external impairment indicators. Internal impairment indicator means, example, asset is physically damaged. External indicator, technological obsolescence. Now the machinery or the digital system, PP&E, intangible assets that you are using are outdated. You have replaced. Then that is an impairment indicator. When you have an impairment indicator, what you do? LKS 36, impairment of assets standard is applicable. What you do? You have to do a impairment assessment, impairment review or impairment testing. So you do the impairment assessment, review or testing when you have an indicator. Now there's a risk of technological obsolescence. There's an indicator. What you do? Do the impairment testing by comparing the carrying value, that is the net book value, with the recoverable value. Recoverable value is the higher of fair value less cost to sell or the value in use, right? So there are two ways of recovering the value of an asset. No? By selling, immediately you sell it, fair value less cost to sell, or else you keep it and generate future cash flows. So what is the present value of the future cash flow that you generate by using the asset and ultimate disposal? So out of these two, you take the higher figure. So that is your recoverable value. If recoverable value is above the carrying value, no problem. But if the recoverable value is less than the carrying value, you need to recognize the impairment loss. Okay, these things you know. Okay, tell me, go through this particular area and tell me what is the relevant accounting standard to this. Take an effort by yourself. Go through and tell me. Right. Okay, before moving there, one thing I wanted to highlight over here, it's mentioned throughout this case study, you talk about the ESG aspect, sustainability aspect. So S1 and S2, I don't need to tell you, it's vitally important. Why I'm not covering in my sessions, because it's already covered by Indonesia. Okay, non-financial reporting part is already covered. So they have a goal to move even into a green hospital. And S1 and S2, right, hot topics in the current environment, ensure that you know the relevant aspects. Okay, so there are exceptions given for the first time adopting companies. Top 100 need to adopt in this year, right? So thereafter it would be rolled forward for the other companies as well. So that ensure that you know S1 and S2, right? Okay, throughout the pre-scene analysis, there are ESG aspects have been discussed repeatedly. So definite question, okay? Right, what it says, okay, read it. Same level of waste management excellence has not yet been achieved in Mathura and Kandy hospitals, the two subsidiaries of HP. So the parent company has two subsidiaries, two hospitals, Kandy and Mathura. The waste management system in those two subsidiaries are not up to the standard of Colombo Hospital, which was established through the acquisition and upgrading of two former nursing homes in 2018. While these facilities have successfully integrated many of the medical and patient care standards of the Colombo branch, waste management remains a pressing challenge. The inherited infrastructure lacked built-in system for biomedical waste segregation, autoclaving, and secure disposal mechanisms. Consequently, current practices are manually intensive, inconsistently followed, and occasionally outsourced to third-party waste handlers without robust oversight. This gap poses a risk not only to the environmental and public health, but also long-term sustainability and the reputation of the branches. Okay, what can be the area? So basically what it says ultimately, main hospital, Colombo Hospital, you have a proper waste management system that they have done it. But in the other two hospitals, because if you look at a hospital that actually put a lot of enormous amount of waste, there are of waste, right? Now if you think about patient care, for surgeries and all that, you use chemical, right? Then you use these cylinders, plastic, right? So where do you put these waste? So if you don't have a proper waste management system, that's a risk to the environment, as well as if something goes wrong, it's not good for your reputation. Even there can be legal actions taken by someone. And hospital business itself risky, because why? You are dealing with patients' lives. There were instances where sometimes ultimately the patient have filed litigations against the hospitals. So all these things indicate that there can be possible or probable obligations to the organization. What is that? LKS 37, provisions, contingent liabilities and contingent assets. Okay, there can be environmental provisions required under the environmental law, or else there can be a constructive obligation where you have to make an environmental provision. There can be litigations, so against which you need to make provisions. Or sometimes you need to decide whether it's a provision or a contingent liability, right? That aspect can be tested. So we know, to any provision, to recognize a provision in the financial statements, 3 conditions. There should be a present obligation as a result of a past event. This present obligation can be a legal obligation or a constructive obligation. Legal means what? Law of the country, environmental law, or because of a court order, or because of a contract that you have entered into, you have a present obligation. Constructive obligation means what? There's no legal obligation, but you as the entity created a valid expectation in the minds of the other people that you would discharge certain responsibilities. Constructive obligation. So the constructive obligation can be established because of a published policy, pattern of a past practice, or sufficiently specific current statement. So in any of these ways, if you create that you would discharge certain responsibilities, now let's say environmental damage, you don't have a proper waste management system. You published environmental policies in your annual report, website, and you communicate in press. This is my environmental policy. Now there's no legal provision, but still you have a constructive obligation to rectify the damage that you made. So you have to make a what? Provision, right? Present obligation as a result of a past event. Outflow of economic benefits are probable. Probable means what? More likely than not. More likely than not means what? More than 50%. It has to be more than 50% chance is there to happen the outflow, and the amount, the rupee value, can be estimated reliably. So if these 3 conditions are satisfied, you have recognized the provision and make the necessary disclosures. Then in this standard there are 2 other things, contingent liabilities and contingent asset. How to decide whether I should make a provision or whether I should disclose this as a contingent liability, right? So before moving to this table, I hope you know this terminology, right? Virtually certain, probable, possible and remote. Probable I already discussed, it is there in the standard as well. What is defined, so out of this terminology, what is defined in the standard is only the word probable. How it is defined? More likely than not. That means more than 50%. It has to be more than 50%. 50.1%. More than 50%. 50% is not probable. Nah? If it is 50% or less, that is possible. 50 or less, possible. Right? Then 95% or more, virtually certain. 5% or less, remote. But out of these 4 things, what is defined in the standard is only the word probable. Other 3 are industry practices. Possible is 50 or less. Remote is 5 or less. Virtually certain is 95% or more. Right. Now, this table is important. If it is a question tested from LKS 37, right, you have to decide whether you have to make a provision or not. Now, if a liability, this is the liability, this is the asset, this is the degree of probability of the cash inflow or the outflow. If it is virtually certain liability, you provide. If it is an asset, you recognize. Assets are recognized only if it is virtually certain. If it is a liability, provide. If it is probable, we discussed in terms of the liabilities, we provide. This is the provision, provide. If it is probable assets, are you recognizing? No. Assets are recognized only if it is what? Virtually certain. If an asset is probable, you just disclose that as a contingent asset. You disclose that as a contingent asset. So this is the difference. Liability, probable, recognize, provide. Asset, disclose. Prudence concept. Concept of prudency. If it is possible, liabilities, what do we do? Possible means what? 50 or less. Disclose. This is the contingent liability part. This is the contingent liability part. If an asset is possible, no disclosure. You don't disclose. Again, prudency. Liability, disclose. Asset, no disclosure. If it is remote, liability as well as asset, no disclosure. I hope you understood. So you have to take these judgments into account when you are deciding whether you should make a provision, whether you should disclose as a contingent liability or do nothing. Right? Okay. And in this pre-scene analysis, throughout we experienced that lot of errors, issues, right, including manual journal entries have been passed. So what it says? During the initial stages of implementation of the ERP system, several challenges were observed in the financial reporting process. These included manual journal entries being recorded without proper review, missing accruals, unadjusted balances, and incomplete financial statements. Okay, tell me. This is actually pure weaknesses in the control environment. Okay, again, when Indonesian was discussing about risk aspect, governance aspect, ethics, he has covered those areas. So what I'm asking from you is, in terms of the financial reporting, what is the standard that can be applicable in this situation? That is applicable in this situation. LKS 8, yes. Accounting policies, changes in accounting estimates and the prior period errors. Right? So out of that, let's say what is applicable over here is the errors. So you would have, basically you would identify errors that has occurred not in the current period but in the prior periods, one or more prior periods. Then what you need to look at is, you need to look at whether that particular prior period error is material. Because if it is immaterial, don't go and adjust the financial statements retrospectively. Because if you find out prior period errors, what you do is you have to adjust the financial statements retrospectively. That means you have to go back and adjust. Not only in the current year, even the comparatives, even before that. Okay, so you have to take the impact and make the adjustment. So that's why I mentioned that you make the adjustment retrospectively if it is a material prior period error. If it is immaterial, don't go and adjust the past years, you just make the adjustment in the current year. So let's assume this is a material error that you have identified during the period. What you do? Retrospective adjustment, which means what? You have to restate the comparative numbers. Not only the comparative numbers, let's assume the errors have occurred in the last 5 years. Right? That is, say you are preparing the financial statements. So this is current year, 31st March 2025. This is your last year comparative, 31st March 2024. So in the current year, you identified errors which have occurred in the last 5 years. Now what do? This is your comparative period. Comparative period, you need to what? Restate. You restate. This is your current year, you restate your comparatives. Now, errors occurred even before the comparative period, but can you go and adjust the financial statements of all the prior periods? That is practically Not possible. Then what do is you take the cumulative impact of all the previous periods before the comparative period, and the cumulative impact is adjusted over here. What is that particular point? Beginning of the comparative period. This is your current year. Cumulative impact of all the prior periods before the comparative period, you adjust at the beginning of the comparative period. Then the standard requires, if you make any adjustment at this particular point, the standard requires you to publish 3 balance sheets, 3 statement of financial positions. One is at the current year, the other one is the comparative year, as well as an additional balance sheet as at beginning of the comparative period. Right? This is a requirement of LKS 1. When entity restate, LKS 1 requires entity to prepare additional statement of financial position at the beginning of the comparative period. Okay, right. What is this? Which standard can be tested? Regulatory uncertainties, foreign exchange limitations affecting the importation of the medical equipment and the essential drugs. What it says? Even if you can remember, during the economic crisis time, healthcare sector was given the prominence because that's important. Because if you look at the healthcare sector, mostly medicines are imported. Right? Government is currently have a plan to manufacture that locally, part of the requirement. Okay, but if you look at most of the items are imported, so that you need foreign currency. Then the equipments, medical equipments are imported. You don't have the technology here in Sri Lanka to manufacture those. So the point what I wanted to mention is there can be foreign currency transaction. If so, LKS 21, effects of changes in the foreign exchange rates. There, we know that when you record a transaction, when you record a foreign currency transaction, you have to record by using the exchange rate at the date of the transaction, spot rate. But what you can do is, as an approximation, you can use the average rate, weekly average or monthly average. Okay, so the recognize the transaction at the exchange rate at the date of the transaction, may use the average rate, maybe monthly or weekly average as an approximation, provided currency is not fluctuated significantly. That we know. Then the point what I wanted to mention is at the year end or at the month end, there can be balances. Right? Especially in this industry, what we can have is foreign currency denominated vendors, suppliers. Supplier payment have not been made at the year end. So then you have a foreign currency liability. What are you going to do with that liability? That depends on whether the particular foreign currency asset or the liability is a monetary item or non-monetary item. All the monetary liabilities, like what? Payable, supplier, vendors, right? All the monetary liabilities, monetary assets. What are the examples of monetary assets? Receivable, okay? Foreign currency receivable. Liabilities, foreign currency payable, foreign currency loans, if any. These are monetary liabilities. Monetary liabilities are converted by using the closing exchange rate. So, and even at the time of the settlement of the transaction, you imported medicine where you need to make the payment in dollars. So at the time of you import the medicine and at the time of you making the payment, exchange rate can be different. So at the time of the settlement, there can be exchange gains and losses. In addition to that, at the year end or at the period end, if you have monetary assets and the liabilities, example, foreign suppliers, payable balances of the foreign suppliers. At the year end, if you have any monetary liabilities, monetary assets, that has to be converted by the closing rate. That would result unrealized exchange gains and the losses. Those unrealized exchange gains and the losses are also to be taken to the profit and loss statement. Right? Then I don't think that in this situation you have non-monetary foreign currency asset or the liabilities, right? Non-monetary means if you have properties in foreign countries. Right? So those things are not applicable, but what is applicable here is the monetary liabilities, payable balances, right? So even I don't think that here you have foreign currency loans. So if it is tested, what you do is just remember that if you have monetary foreign currency asset or the liabilities at the period end, you need to convert by using the closing rate and recognize the unrealized exchange gains and the losses. Those unrealized exchange gains and the losses are taken to the profit and loss statement. Right. Okay. Then before completing the accounting standards, I'm not going to go through the financial statements. You have been given the financial statements of Healthcare PLC group and the company accounts. Then you have been given the financial statements of a possible acquisition, that is a pharmaceutical company, right? Then you have been given the financial statements of the Kandy hospitals. By going through these financial statements, there are areas which examiner can think of testing in the examination. So there are 3 areas that I have included: income taxes, the topic deferred tax, because there are deferred tax assets and the liabilities in all 3 sets of financial statements. Then you have the retirement benefit obligations, LKS 19, employee benefits, and there are lease liabilities and right of use assets. So by going through the financial statements, if you look at LKS 12, LKS 19 and SLFRS 16 leases can be tested. Okay, so these are the areas which are covered in terms of the accounting standards. What we can do is, I spend a lot of time on that, especially on SLFRS 15. So what we can do is, we can take a small break, 10 minutes, before we move to the most important topic of what? Consolidation. That is the heart of the pre-scene discussion. So because of that, we spend a lot of time, almost 2 hours and 30 minutes, 25 minutes. So we'll take a 10 minutes break, and after that, we'll discuss about the possible areas of the consolidation. So let's start. So now the most important area of the pre-scene analysis, what are the possible consolidation related questions that can be tested in the examination out of the information given in the pre-scene, right? Now we already looked at, before moving there, so the applicable standard in terms of the consolidation areas are mainly SLFRS 3 business combination standard and SLFRS 10 consolidated financial statements. These are the 2 main standard where the group reporting, what is important for the group reporting aspects, right? Then there are standards for the joint ventures and associates as well. I'll come there in a little while, but predominantly these 2 are the standards. Now if you look at the group structure, current group structure, parent companies, Healthcare PLC, it has 3 100% owned subsidiaries. It was clearly mentioned, Kandy Hospital and Mother Hospital were, these 2 hospitals were acquired, right? So 100% shareholdings were acquired. In terms of the laboratory, right, Healthcare Laboratory Private Limited, it was not mentioned about the percentage. But if you are clever enough, you can identify this as 100%, because if you look at the consolidated financial statements of the Healthcare PLC group, you don't have non-controlling interest. You don't have non-controlling interest in the statement of financial position, as well as entire profit is in the statement of profit and loss. Entire profit is attributable to the equity holders of the parent, so that you can figure it out. Even in the Healthcare Laboratory Private Limited, Healthcare PLC should have 100% holding, right? So this is the current group structure, okay, right? Then, so this I have taken from the pre-scene. What it says is, in a strategic move, HP decided to strengthen operations at Healthcare Kandy Hospitals Private Limited and deal with its high cost structure, including the high short-term borrowings cost, right? So what they want to do is, they want to strengthen the Kandy Hospital, but there are some issues. One is high cost structure as well as high borrowing cost. So maybe at the moment company is not that profitable. You have been given the financial statements of the Kandy Hospital. So where again, I'm not going to go through the financial statements or the pre-scene because you would have read that multiple times. Financial statements have been looked at. If you look at the profitability is low, right? Comparing with the group profitability, you have been given the consolidated P&L, no? So comparing with the group profitability of the Kandy Hospital is low. Okay, so so it's mentioned that cost structure costs are high, operational costs are high, as well as high borrowing cost. Sunil Gomez, an experienced independent lawyer who currently serves as one of the independent directors of the group, has been identified to assume the role of Chief Executive Officer of Healthcare Kandy Hospital. His appointment is expected to bring a fresh leadership perspective and drive much needed operational and financial reforms to improve the hospital's sustainability and long-term performance. So basically what it has been done is, as the performance were poor, so one of the independent non-executive director of the group, that is Healthcare PLC, so he is actually a director of the Healthcare PLC, he is a independent non-executive director, he has been appointed as the CEO of the Healthcare Kandy Hospital. Now there's a corporate governance matter, I'm not going to cover that, right, because as soon as you being appointed as an executive of a subsidiary of yours, can you treat that particular director as an independent director anymore, right? So that's corporate governance. So Indonesia would have discussed that. So because of that, I'm going to cover that. So I'm looking at the financial reporting aspect, right? So now this particular information together with the financial statements, both statement of profit and loss as well as the statement of financial position of the Kandy Hospital is given in the pre-scene. So what can you figure it out of that? What do you think about? So what can be the possible consolidation area that can be tested? It can say, even after doing, or even now this particular CEO has done a study, right? That can be the unseen, that is your examination. He has done a study, it seems that this is difficult to turn around depending on the cost structure and the borrowing cost, and there are other operational difficulties of the Kandy Hospital because they have mentioned qualitative factors like getting the consultants are difficult, okay, in those hospitals in Kandy and Mathura. So by giving number of reasons, they might decide this particular hospital is to be disposed. So there can be a what? Console adjustment, or the console transaction would be a disposal of the Kandy Hospital. Okay, disposal of that, because financial statements are given. So examiner would ask, assume that 31st March 2025 at the reporting date, so this particular hospital is disposed. Okay, so then how do we do the accounting? What is the implication of the financial statements? Because you have been given the, remember in this situation, in this particular question, you have been given the consolidated financial statements of Healthcare PLC and the company financial statements of Healthcare PLC. Consolidated financial statements of the Healthcare PLC, company financial statements of the Healthcare PLC, as well as the company financial statements of the Kandy Hospital. Examiner can say that, assume that disposal is taken place at the last date of the financial year, right? Then you need to calculate the disposal gain or loss, disposal profit. In addition to that, you need to prepare the consolidated financial statements assuming that this disposal is taken at the year end. So then you have to take out the assets, liabilities of the Kandy Hospital from the consolidated financial statements. Okay, in this particular question there was no goodwill figure, right? Otherwise, when there's a disposal of a subsidiary, you have to do three things. You have to remove the asset and the liabilities. Then you have to remove the goodwill figure. And you have to remove the non-controlling interest figure with regard to that subsidiary. But in this situation, fortunately, you don't have a goodwill figure as well as you don't have a non-controlling interest. So your job is easy. You just need to remove the net assets. On the other hand, examiner will give you the sales proceed, you need to calculate the disposal profit. Okay, so what is the possible question? This is the current group structure. So Healthcare PLC has 3 subsidiaries, 100% owned. Out of that, Kandy Hospital can be disposed. So if it is disposed, this would be the revised group structure. You just have only 2 subsidiaries, Healthcare Laboratory and Mathura Hospital. Okay, so as I mentioned, what you need to do is you have to account for a disposal of a subsidiary. And when you dispose a subsidiary, right, when you dispose a subsidiary, you are losing the control over that subsidiary. So that you have to calculate the disposal profit. Now, in theory sessions, we discussed number of disposal scenarios. So now, if you look at this particular situation, at the moment, we have 100% holding of the Kandy Hospital. You can dispose entire 100% and your holding would be 0. This is called as an entire disposal. It can be an entire disposal. Okay. Then what is most probable is actually this. It can be an entire disposal if a disposal is tested. But examiner has the liberty to ask anything. So there can be a situation you had 100, you dispose 70%, you retain 30%. Then what happened? Earlier it was a subsidiary, 100% owned. Now 30%, it has become an associate. You have the significant influence. You don't have the control. Or else you had 100%, you dispose how much? 90% and you retain 10%. Then what happened? Earlier it was a subsidiary, now it has become a normal investment. SLFRS 9, financial asset. Okay. But as I mentioned, what is highly possible is the first one, entire disposal. But it can be this or this or this. So what one common thing of the first 3 scenarios are is what? You are losing the control. Control is what? Lost. Entire disposal, 100% to 0. Subsidiary has become an associate. Subsidiary has become a normal trade investment. All these 3 scenarios, control is lost. So if the control is lost, accounting is similar in all these 3 scenarios. What you do is, if the control is lost, you have to calculate the disposal profit. Okay, so there's a formula of calculating disposal profit. So what is the formula? You need to take the sales proceed plus, if you take this situation to explain, sales proceed of this 70%. Okay, plus fair value of the retained interest, fair value of this 30%. Sales proceed of the 70% plus fair value of the retained interest, investment, 30% holding at the disposal date. You add these 2 together. Out of that you deduct net asset at the date of disposal plus goodwill at the date of disposal minus non-controlling interest at the date of disposal. But in this situation, you don't have any non-controlling interest as well as what you don't have a goodwill figure. So because of that, what you do is you need to deduct the net asset of the subsidiary at the date of disposal and calculate the disposal profit or loss. That particular disposal profit or loss you need to include in the consolidated profit and loss statement. Okay, it is taken into the consolidated P&L. Sorry. So you have to be thorough with the accounting for disposals, right? So you should have done number of questions. So because there were multiple questions in terms of the disposal in the past papers, and during the classroom you would have done number of questions. So you need to be very thorough with the accounting for disposal in a group scenario. Then the 4th scenario would be 100% you dispose 30% and you retain 70%. So what is the difference of the first 3 scenario and this? In this scenario, even after the disposal of this 30%, it is still a subsidiary. You retain the control. Control is not lost. So accounting for this is totally different to the first 3 scenarios. Because here, as the control is retained, you don't calculate any disposal gain or loss. You continue to keep the goodwill figure. So it's a transaction between equity holders. Earlier there were no non-controlling interest, but after the disposal, non-controlling interest is 30% and parent has 70%. So it is a transaction between the equity holders. Okay. So you have to look at how much of proceeds, what you received out of this disposal of 30%, compare that against the increase in the non-controlling interest, because earlier non-controlling interest was 0, now 30%. So the NCI value, non-controlling interest value, has gone up. On the other hand, you receive proceeds for this 30%. You compare these two and adjust the difference in equity. So that's why I mentioned that it's a transaction between the two equity holders, parent company and the non-controlling interest. No gain or loss is recognized in P&L. Goodwill is not derecognized or adjusted. So this particular transaction has to be accounted in equity, directly in equity. Yet again, I'm not going to explain how to do the accounting. So when I explain, I believe that now you can remember what to do. So if you can't remember, go and refer your notes again or watch the videos. Understand that. Okay, right. That is about the disposals, and that is about the first possible scenario that can be tested in the pre-scene. So what I have explained is it is discussed over here, right? Different disposal scenarios, right? So what I have explained is there in this slide. You all can go through. Right. Then look at this particular information and tell me, by reading this, what can happen. So it is obvious actually. You can predict what can happen here. Well, it says a potential merger acquisition target identified. SLFRS Pharmacy Private Limited, a well-established and reputable pharmaceutical company with long-standing agency rights to several European origin branded medications. SLP, that is SLFRS Pharmacy, under the ownership of Dr. Stanley De Silva, has built a strong market presence over the years. However, with no clear succession plan in place, Dr. De Silva has expressed interest in either merging the company or selling it to a credible healthcare entity. The proposed integration with SLP presents a timely opportunity for HP Healthcare PLC, our company, to strengthen its supply chain, enhance its procurement reliability, and reinforce the commitment to deliver safe and effective medical treatment to patients across hospital network. Right. Now, if you look at the hospital operation, one of the critical aspects is actually what? The medicine, right? Obtaining quality medicine that is used for the patient care. Now, what they can do is, now if you look at their group structure, they have 3 hospitals and a laboratory services. But they don't have a pharmacy within the group, right? Well established, reputable pharmaceutical company, right? Pharmaceutical company means not a pharmacy actually, it's like pharmaceutical importation, right? That's why it's mentioned that with long lasting agency rights to several European origin branded medications, right? So now if you look at live example, what I can give you is actually Hemas, right? If you look at Hemas, they have couple of hospitals. One is in Wattala, other one is in Talawatukoda. Okay, and also they have an arm, so they have a pharmaceutical arm as well. So import medicines under number of agencies. Okay, so that actually supports your hospital operation, because as I mentioned, one of the important aspect is your supply chain when you are operating a hospital. Okay, quality medicines, and here it's mentioned that they have agencies with European countries. So obviously this would be an ideal opportunity for this group to enhance its operation within the value chain. So what is the, now even the particular owner, the owner of this pharmaceutical company is what? Dr. Stanley De Silva. Okay, he doesn't have any succession planning, so that he wants to sell this to someone. And this is an ideal opportunity, as explained in this pre-scene, for the healthcare PLC to purchase this company. That means what? Obviously, and you have been given the financial statements of this company, SLFRS Pharma Private Limited, SLP. You have been given the financial statement, both statement of profit and loss and the statement of financial position. Examiner can give you a scenario where examiner would say that company has, or healthcare PLC has decided to acquire this pharmaceutical company. Balance sheet is given, right? P&L is given. Assume that the acquisition is taken place as at the year end, 31st March 2025. Prepare the consolidated financial statements. So then you have been given the already given the consolidated financial statements. What you do is you need to do the consolidation adjustment. So you have to apply the what? Acquisition accounting. So which means you have to calculate the goodwill, you have to measure the assets and the liabilities of the acquired subsidiary at fair value. If there's any non-controlling interest, has to be taken into consideration, right? There can be fair value adjustments, there can be deferred tax adjustments, right? There can be deferred consideration, contingent consideration involved in this transaction. So you have to take into those and consolidate the new company, that is SLFRS Pharma Private Limited, into the consolidated statement of financial position. That's a possible question. I think that is the most probable out of all these things. Definitely it says that, I can't say definitely, sorry, it is actually examiner has to decide. So this is highly likely where it can be tested in the examination. So this is the current group structure, as I mentioned earlier. So 3 subsidiaries, 2 hospitals, Kandy and Mathura, as well as the laboratory company. So revised group structure would be what? SLFRS Pharma Private Limited will be acquired by the parent company Healthcare PLC, and you are asked to prepare the consolidated financial statements, including the SLFRS Pharma PL, including SLFRS Pharma Private Limited. Prepare the consolidated statement of financial position of Healthcare PLC as at 31st March 2025. That would be the question, right? Now, in this case, we consider SLFRS Pharma is acquired by Healthcare PLC. Okay. Sometimes, if examiner wants to make it a bit complicated, he can give you a vertical group scenario. Instead of acquiring SLFRS Pharma Private Limited by Healthcare PLC, examiner can say that SLFRS Pharma Private Limited will be acquired by one of the subsidiaries, maybe through the laboratory company, Kandy Hospital or Mathura Hospital. If it is a vertical group, I believe that it would be acquired through Laboratory Private Limited. Okay. It's examiner's decision, right? It can be under Kandy or it can be under Mathura, same thing, no? It doesn't matter under what company it is acquired, it's a vertical group. Then the accounting, financial reporting is same. Don't worry about that. Under which company this is acquired. So wherever it is acquired, if it is a vertical group, you follow the same aspect or the same method in terms of the financial reporting. So what can happen is, in that time, the group structure, this is the original group structure. Healthcare PLC has 3 companies, laboratory company, Kandy Hospital and Mathura Hospital. And I assume that acquisition is taken place through laboratory company. So if that is the case, this would be the revised group structure. Okay. Revised group structure, Kandy Hospital and the Mathura Hospital will be remained as it is. So this pharmaceutical company is acquired under the laboratory. So then Healthcare PLC has a subsidiary as well as a sub-subsidiary. So laboratory company is the subsidiary, pharma company would be the sub-subsidiary. So you should be aware about, okay, how to prepare the consolidated financial statements of the vertical group. Again, examiner would say that acquisition is taken place at the year end, 31st March 2025. Then the same consolidation adjustments like goodwill, non-controlling interest, if it is not 100% acquisition, non-controlling interest, fair value adjustment, deferred tax impact of these fair value adjustments, deferred consideration, contingent consideration. Basically, you have to apply the acquisition method of accounting, consolidation. Right, I now told you two scenarios. Under the second scenario, two options. What are the two scenarios? First one, there can be a disposal. Kandy Hospital can be disposed because the financial statements of the Kandy Hospital is given. Second scenario, it is bit obvious as well. Acquisition of pharmaceutical company. Acquisition of pharmaceutical company can be done by the parent company, that is Healthcare PLC, or else acquisition of the pharmaceutical company can be done by one of the subsidiaries, example through the laboratory company. So then you have a vertical group structure. Are we clear? Right, in all these situations, what examiner can ask you is, assume that disposal or the acquisition is taken place at the year end, prepare the adjusted consolidated statement of financial position, because you have been given the consolidated statement of financial position. If it's an acquisition, what will happen? If it is a disposal, what will happen? What are the adjustments, necessary adjustments? Which you have discussed, right? Acquisition questions, disposal questions, number of questions have been discussed, past papers have been done, model questions would have been done, right? So, simple. If examiner wants to make it a bit more complicated, what can he do? What can he do? This is the group structure, no? Again, back to the normal or the original group structure. Parent plus 3 subsidiaries. What can he do? He can test both acquisition and the disposal together. Possible, no? And asking you to prepare the consolidated statement of financial position after the disposal and acquisition. Right? That means, let's assume acquisition is a direct acquisition by the parent company. Then what will happen? Kandy Hospital won't be there. This is going out. What is remaining? Laboratory and the mother hospital. This is going out. On the other hand, pharmaceutical companies getting added to the group. So the revised group structure would be this. Laboratory company under the parent company. Then Kandy Hospital is going out. So what is remaining is only Matara. Kandy Hospital is getting disposed. Then you are acquiring SLFRS Pharma Private Limited pharmaceutical company. So then parent has how many subsidiaries? 3 subsidiaries. Kandy Hospital is going out, pharmaceutical company is coming in. The question would be, again, to what? Prepare the consolidated statement of financial position, assuming that both acquisition and disposal is taken place 31st March 2025. Is that clear? So then you have to be really thorough in acquisition adjustments, disposal adjustment, take the impact and re-prepare consolidated statement of financial position. Starting point is the given consolidated statement of financial position. From there, what are the adjustments to the additions? What are the adjustments to the disposal? Okay, take one by one. What are the adjustments of the disposal? What are the adjustments of the addition? What are the final numbers? Okay, right. So basically in all these cases, what you do is, if it is an acquisition, so I discussed about the disposal theory part as well. I told you there are different scenarios of disposal. Control is lost, control is not lost. Under the control is lost, there are 3 scenarios. Entire disposal, subsidiary to associate, subsidiary to normal investment. Right? Similarly, I discussed about the possible acquisitions, number of acquisitions. In all these acquisitions, what you do is you have to follow the acquisition method. Acquisition method means the consolidation. So the acquisition method has 4 steps, right? You have to identify the acquirer, who the acquirer is, whether it is the parent company or whether it is a subsidiary. Vertical group structure. In the vertical group situation, acquirer is, my example, acquirer is what? Laboratory company. Who is the acquirer? Identifying the acquirer. Determining the acquisition date. In the exam, it would be on year end, 31st March 2025. At the year end, assume that this acquisition has been taken place. If so, how the consolidation financial statements would look like. Consolidated statement of financial position would look like. Then when you when you follow the acquisition method, when you are preparing the consolidated financial statements, when you are preparing the opening consolidated statement of financial position, you have to recognize and measure all the identifiable assets and the liabilities of the acquired subsidiary. This is what I mentioned. There can be fair value adjustments of PP&E. There can be intangible assets which are not recognized by the subsidiary in their individual financial statements, but for the group purpose, you have recognized. Okay. There can be contingent liabilities in the subsidiary that is just being disclosed in the subsidiary's individual financial statements, but for the consolidation purpose, you have recognized those. There can be deferred tax implications on the fair value adjustments. There can be deferred consideration, contingent consideration of this acquisition. So all of these things are to be taken into consideration. Finally, you have to calculate the goodwill and the value of the non-controlling interest and include that in the adjusted or updated consolidated statement of financial position. Okay, right. Then any other scenarios of consolidation that can be tested? Any other scenarios? If examiner wants to be bit unpredictable, he doesn't like now he has given you a pre-scene, everybody is predicting what he is going to test. Normally as a human being, he doesn't like it, no? Right? He wants to be a bit more unpredictable. What can he do? Right? So this is the group structure, no? Parent company and 3 subsidiaries, laboratory and 2 hospitals, Kandy and Mathura. He can say, based on the information, it seems that if it is an acquisition, it's a acquisition of the entire company. Now I am talking about the pharmaceutical company. So what we looked at earlier is either the parent company directly or else through a subsidiary you acquire the pharmaceutical company, make it to a subsidiary. But examiner might say that, okay, now there's a owner, no previous owner, Dr. Stanley De Silva. So his problem is the succession planning. He is the owner of the pharmaceutical company. No? He would think that, okay, if someone else is also involved in the business, I don't need to fully involve, but I don't want to dispose the entire business. I can make it to a joint venture. Okay, so in that situation, what can happen is Healthcare PLC acquire 50% of SLFRS Pharma Private Limited. Okay, pharmaceutical company. Out of that, because earlier it was 100% owned by Stanley De Silva, Dr. Stanley De Silva. What he is doing is he is selling 50% of the stake to Healthcare PLC. Then what will happen? 50% of the pharmaceutical company is owned by the parent company Healthcare PLC. 50%, remaining 50% is with Dr. Stanley De Silva. Then Dr. Stanley and Healthcare PLC has entered into an agreement where the relevant activities of SLFRS Pharma is decided with the unanimous consent. So basically what does that mean is Healthcare PLC and Dr. Stanley De Silva has the joint control over this pharmaceutical company. Right? So is that understood? Is that understood? That is clear, no? Right. So how to account if this is a joint venture? Because we have to prepare the financial statements from Healthcare PLC's point of view. No? Then Healthcare PLC has 3 subsidiaries, right? Laboratory company, Candy Hospital, Mother Hospital, plus a joint venture. What is the accounting treatment for the joint venture? LKS 28, investment in associates and joint ventures. According to that, joint ventures are equity accounted. Okay, cost plus share of post-acquisition net assets. So in this case, what is your share? 50%. Cost plus, to acquire this 50%, how much you pay, that is your cost, plus share of 50% of post-acquisition net assets. Okay. Then, hope I am not confusing you, right? Telling you too many things. Because as I said, so the examiner has liberty to test any of these things, right? It's not within our control, not within my control or your control. He is the one who is deciding what to check. So he has the liberty to check any of these things because all these things are within the syllabus. Now, what did I explain up to now? First of all, a disposal of Candy Hospital. Second one, acquisition of pharmaceutical company. That acquisition can be happen directly by the parent company or through a subsidiary, where it would lead to a vertical group situation. Third one, both together, acquisition of pharmaceutical company and disposal of Candy Hospital. Right. Fourth one, what I said was this. So, Healthcare PLC acquire 50% stake of pharmaceutical company and make it to or enter into a joint venture agreement, joint control agreement with Dr. Stanley De Silva. Okay. Finally, what would happen is you can come this scenario with the disposal as well. What the disposal? So now here you have laboratory company, Candy Hospital, Mother Hospital, and the joint venture. What can happen is this Candy Hospital can be disposed. So the scenario would be then you are disposing the Candy Hospital, right? And you enter into a joint venture with Dr. Stanley De Silva for the pharmaceutical company. Then what would be the group structure? This is the original group structure. Parent company, laboratory, Candy Hospital and Mother Hospital. What would be the scenario? You are disposing Candy Hospital. Earlier you had Candy Hospital, now Candy Hospital is no more there. You are disposing the Candy Hospital. That's the disposal which we have already discussed about. Then you enter into a joint venture with Dr. Stanley De Silva for the pharmaceutical company. You have 50%, Dr. Stanley is having 50%. You are preparing the financial statements from the Healthcare PLC's point of view. So from Healthcare PLC's point of view, this is a joint venture. You have to apply LKS 28, investment in associate and the joint ventures. You have to follow the equity accounting. Okay, so then examiner can ask, the question would be, take into consideration the disposal of Candy Hospital and take into the consideration of entering into the joint venture with Dr. Stanley De Silva in terms of the pharmaceutical company and prepare the consolidated statement of financial position yet again at the reporting date 31st March 2025. Hope you are clear. Okay. So I already told you in terms of the consolidation, there are two standards which are important. I already told you, SLFRS 3 business combination and SLFRS 10 consolidated financial statements. If it is a joint venture, right, so it is covered under SLFRS 11 joint arrangement, and accounting for the joint ventures are covered under LKS 28 investment in associates and the joint ventures. Now in terms of SLFRS 11 joint arrangement, what do you mean by joint arrangement? Where two or more parties jointly controlled a particular arrangement. So basically, what does that mean by jointly controlled? relevant activities are decided based on the unanimous consent. Both parties has to agree. Now if I go back, relevant activities means activities which significantly affect the return of this particular entity. So the relevant activities are decided, made with the unanimous consent of Healthcare PLC and this particular individual, Dr. Stanley De Silva. Okay, so a joint arrangement is something where you have you make the decisions based on the unanimous consent. This will only be applied if relevant activities require unanimous consent of those who collectively control the arrangement. When it comes to the joint arrangements under SLFRS 11, there are two types of joint arrangement. Remember, the name of the standard is what? Joint arrangements. There are two types of joint arrangements. Joint operations or the joint ventures. What's the difference? Joint operation means there's no separate entity. For example, let's say there are two parties who got together. Let's assume Kamal and Sunil. Kamal and Sunil, they got together, and what they want is actually, Kamal said that, okay, I will do the manufacturing activities. Sunil said that I will do the sales and distribution and marketing activities, right? So they manufacture a product. Okay, first party manufacture the product, second party has done the marketing, distribution, and they collect the revenue and they share this revenue equally between these two parties. It's just operation. There's no separate entity established. It's just an activity, right? So the parties jointly control the assets and the liabilities. No separate entity established. So that's a joint operation. So that is one type of joint arrangements. The other type of joint arrangement is what we discuss in this situation is the joint venture. What do you mean by joint venture? Joint venture means they are separate entity. Now in this case, this is the entity, SLFRS Pharma Private Limited. Okay, they are separate entity. Parties have the rights to the net asset of this entity. Earlier in the joint operation, parties are having the right to the individual assets and the individual liabilities because there's no separate entity. But in the case of joint venture, what happens is there's a separate entity so that each venturer, in this case Healthcare PLC and Dr. Stanley De Silva, has the right to the net assets, not to the individual asset or the liabilities. Okay, they are not having the joint control over the assets and the liabilities. They are having the joint control over the net asset of this entity, and they are separate entity established if it is joint venture, right? So the name of the standard is joint arrangement. There are two types of joint arrangements, joint operations and the joint ventures. So I have explained you what do you mean by joint operation and what do you mean by a joint venture. What we have in this situation is actually a joint venture. If examine a test, what I have just mentioned, in that case, joint arrangement where parties have the joint control of the arrangement and have rights to the net assets of the arrangement. Okay, generally a separate entity is formed to conduct the activities of the joint venture. Okay, if it is a joint venture, what is the accounting treatment? That is decided by a separate on other standard. What is that? LKS 28. What is the name of LKS 28? Investment in associates and joint ventures, not joint arrangements. Huh? Okay, so the name is, this is only for the joint ventures, accounting for the joint ventures, not for the joint operations, because there are two types of joint arrangements, no? Joint operations and the joint ventures. Accounting for the joint venture, what we have in this scenario, a separate entity, parties have the rights over the net assets, parties have the joint control over the net assets of the separate entity. So the accounting is covered in LKS 28, investment in associates and the joint ventures. So what is the accounting treatment? Equity accounting. Okay, similar to an associate, accounting for a joint venture also equity accounting. Right? Clear? How to do the equity accounting? If you can't remember, you have to go and refresh your knowledge, right? Watch the videos, read the tunes, understand equity accounting in the statement of financial position, mainly in the statement of financial position, and the equity accounting in the profit and loss statement, right? Okay, right. So these are the possible areas in terms of the consolidation, what it can be tested in your examination. I mentioned number of scenarios. So ultimately you need to be ready in terms of accounting for disposals, accounting for acquisition, as well as accounting for the joint ventures. Okay. But sometimes what will happen, as I mentioned, examiner doesn't want to be seen himself as everyone can predict the question sometimes. Because of that, there were instances you sometimes test questions which are not having or which doesn't have any relationship with the pre-scene. Right? For example, let's say now we are talking about a pharmaceutical company here. Right? SLFRS Pharma Private Limited. In the unseen, in the examiner might say that a totally a different company. Okay? Totally a different company. And examiner might say that, okay, acquire that particular company. Or it can be another laboratory. It can be another hospital. It can be a different pharmaceutical company. Do you need to worry? No, right? Because why? If you know the accounting for the acquisition, whether it is SLFRS Private Limited or any other company, any other pharmaceutical company, hospital or laboratory or any other business, doesn't matter, it is the same accounting treatment. Don't be panic in the examination. Right? Even the disposal. Instead of candy, in the examiner might say that company is going to dispose the laboratory and want to exit from that business. Because they have hospitals now. So they just want to be in the hospital business, want to dispose the laboratory. All happen. Then again, don't panic because you know it's a disposal. You were getting ready for the disposal of Candy Hospital, but instead of that, it's a laboratory. Same accounting treatment, same financial reporting. So don't be panic. Okay. Or else if the examiner wants to make the matter a bit more complicated, what he can do is, now think about the financial statement that he has given in the pre-scene. What are the financial statements that he has given in the pre-scene? I hope you have the pre-scenes with you, right? I'm not going to go through because I can spend time effectively by telling you something what you don't have in your hand, because pre-scenes are with you. I don't want to go through the pre-scene and show the financial statements. You had enough time this session to go through and get familiarized by yourself. You have been given the consolidated financial statement. Now if I go to the presentation, okay, this is the existing group structure now. You have been given the financials of Healthcare PLC. Consolidated accounts are given. As well as you have been given the company accounts of Healthcare PLC. Both group and company accounts are given, no? Then you have been given the financial statements of the Candy Hospital. Company accounts are given. Both balance sheet and P&L given. Then examiner, in the unseen, examiner might say that, or examiner might give you the information of Mother Hospital, financial statements of the Mother Hospital. Okay, financial statements of the Mother Hospital is given. And he will tell you, Healthcare PLC decide to dispose what? Laboratory, without giving the financial statements of the healthcare laboratory. Once it was tested. Similar question to this. Then what are you going to do? You have the console accounts of Healthcare PLC. Company accounts of Healthcare PLC. In the pre-scene. Again in the pre-scene you have the financial statements of the Candy Hospitals. Unseen, or in the examiner is giving the financial statements of the Mother Hospital. Now tell me, can you derive the financial statements of the healthcare laboratory? Can or can't? Yes, you can. Out of the consolidated financial statements, once everything else is given, what is the remainder? An examiner might say that assume there are no intercompany balances. So then what you can do? You can derive the financial statements of the healthcare laboratory. And the question would be to dispose healthcare laboratory. Then you know what is the accounting treatment for the disposals, which we have discussed. But the point is, there's some number crunching to be done other than the knowledge about the consolidation to derive the financial statements of healthcare laboratory private limited. If examiner wants to put you into deep end, right? As I said, so he has the liberty to test anything. Okay, so because of that, we have to get ready for the worst case. So the worst case is all the scenarios that I mentioned. Okay, right. Now also remember, this is the final pre-scene, and this pre-scene unseen discussion that he can have, because after this session it would be the new syllabus. No, there are no pre-scenes, one scene, so nothing. What you have is the capstones. It's a different setup. Okay, different arrangement. So because of that, you ensure that you complete the examination this session, right? Don't procrastinate. Anyway, now you don't have time to rethink. You must sit for the examination and complete the exam. Right, okay. Okay, I explained. Right, now we are done with the accounting standard related questions, possible areas, as well as consolidation related possible areas discussed. What is at last is analysis and the interpretation, because if you look at the recent examination, always there were questions from analysis and the interpretations. Initially, this particular topic, analysis and the interpretation, was tested from the DuPont analysis, ratios relating to the DuPont analysis. Thereafter, examiners moved into the other areas as well, because there's a rationale of test in this, right? Because why? Who are the primary users of the financial statements, right? So your investors, potential investors, and the lenders who provide the capital to the business. Now, these primary users are making decisions about the financial statement of these primary users are making decisions by looking at the financial statements. So when they are making decisions, if you are looking at an equity investor, 3 decisions, no? So let's say when you are analyzing a PLC, by an investor, 3 decisions he can make, no? Buy shares of that company, sell shares of that company, or hold shares of that company. Buy, sell, hold. So for that investor to make decisions, he has to analyze and interpret the financial statements. So the most commonly used analysis and the interpretation method is the ratio analysis, right? That's why this is tested in the examination. Okay, how an investor would read and understand the financial statements. Now, initially this topic was tested, this ratio analysis was tested through the DuPont formula. I hope all of you know this. One of the important ratio, profitability ratio for any organization is return on equity. How much of return that the equity holders are generating by putting their money into this business, return on equity. So how to calculate the return on equity? You take the how to calculate the return on equity? Net profit or net income divided by equity. Okay, so always having a higher return on equity is better for the company. Now this return on equity is split into 3 areas. profitability, efficiency of utilizing the asset, and the gearing. What is the profitability ratio? Net profit margin. This is NP margin. This measures the profitability. This is called as NP margin, or net profit margin. Right? Then always having a higher NP margin is better for the company. Having a higher profitability is better for the company. Then what is this? Revenue divided by total assets. So this is what? Asset turnover. So this ratio is called as what? This is, as I mentioned, NP margin. This particular ratio is asset turnover. TO means turnover. So this particular ratio is measuring efficiency of asset utilization. What does that mean? What is the meaning? For 1 rupee investment in asset, how much of revenue that it generates? So always better to generate more revenue from 1 rupee investment in asset. Okay, high asset turnover is better for the company. It shows the efficiency of utilizing the assets. The third one is, this is equity multiplier. Equity multiplier. So this measures actually the gearing, capital structure. How much of your assets are funded through the shareholders' equity and how much it is funded through debt. Okay, so let's say if you fund higher portion of the assets through the shareholders' equity, this ratio is low. Let's say total assets are 100, shareholders' equity is 50. 100 divided by 52. Right? That means equity multiplier is 2. Let's say assets are 100, shareholders component or the shareholders equity is 4. Sorry, 25. What was the previous number? Total assets are 100, shareholder equity is 50. Then what is the answer? Equity multiplier is 2. Right? If the total assets are 100, shareholders equity is 25, what is the equity multiplier? 4. So it measures how much of portion is funded through the shareholders equity and debt. Having a lower ratio means what? You fund through the equity, the portion that is funded through the equity is high. Having a higher ratio means you funded most of your assets through debt, because equity component is earlier 50, now 25. Now equity component is getting reduced, mean you fund most of the asset through debt. Then the equity multiplier is going up. Equity multiplier is going up. Equity multiplier is going up means your gearing is going up. So basically what does this ratio says is, it's going up means gearing is increasing. Debt component is getting increased. If this ratio is coming down, gearing is getting reduced, debt component is getting reduced. Now in terms of the return on equity, having a higher ratio here generates higher return on equity. If you look at the DuPont analysis, having a higher ratio here, you are getting a higher return on equity. That is a good thing. But remember, having a higher ratio here means your gearing is high, your debt component is high. That would lead to a financial risk to the organization. What do you mean by financial risk? Financial risk means when you have more and more debt, you have fixed commitments. You must pay interest now. Even though you make profits or even though you make losses, you must pay interest. It's a fixed commitment. Having more debt means what? You have more fixed commitments. So that is the financial risk that you have. But when you have equity, if you have profits, you pay dividends. If you don't have profits or making losses, don't pay dividends. Financial risk is low. Right? Okay. Understood. So what examiner can do is, now you have been given number of financial statements. Healthcare PLC consolidated numbers. Healthcare PLC company numbers. Then this new pharmaceutical company numbers, Candy Hospital company numbers. Examiner can test DuPont analysis for one of these companies where the financial statements are given. You should be ready to analyze that. Okay, do the computation and interpret about it. Right? So this can go into this particular ratio. NP margin can be further drilled down into another 3 areas. Okay, so this particular component, first component, NP margin, can be further drilled down. What are they? Operating profit margin. How do we calculate the operating profit margin? Profit before interest and tax divided by revenue. That would give you operating profit margin. Then interest burden. How to calculate the interest burden? Profit before tax divided by profit before interest and tax. Okay, so the difference between the profit before tax and profit before interest and tax is the what? Interest. Having a higher interest will reduce this ratio. Having a higher interest will reduce the ratio. Okay. Then the tax burden. How to calculate that? Profit after tax divided by profit before tax. So the difference between the profit before tax and the profit after tax is the tax. When you have a higher tax figure, so this ratio is low. Higher tax figure means ratio is low. That means tax burden is high. Okay. So now what will happen ultimately? When you look at this to this would be cancelled. This to this would be cancelled. Ultimately, what is getting remained? Profit after tax divided by revenue. What is that? NP margin. Profit after tax divided by revenue. NP margin. Similarly, in the DuPont formula, revenue to revenue, net off. Total asset to total asset, net off. What is remaining? Net profit divided by shareholders' equity. That is what? Return on equity. That's it. About the DuPont formula, I discussed more than enough, right? Went into a bit of a theory as well, as it's important. And not tested actually, recent examinations, right? So because of that, as the last time under the current syllabus, the examiner can test this again. Right. Then the other ratio analysis, right? I told you, you have been given number of financial statements. So the examiner can test the gearing related ratios, liquid related ratios, efficiency related ratios, profitability related ratios, right? In one set of financial statement, for example, let's say before acquiring, now you have been given the financial statements of this new pharmaceutical company, SLFRS Pharma Private Limited. In the unseen, examiner would give you industry benchmarks. So what are the profitability ratios, or what are the gearing ratios in the industry? So compare the financial statements of this new acquisition target against the industry averages. Or else, examiner can give you the information of a competitor, comparing with the competitor how this new acquisition target looks like. Okay, ratio analysis. It can be any of these ratios: profitability, efficiency, liquidity, gearing. I'm going to teach you this, you know this. Or else you can do the DuPont analysis. Based on that, you do the DuPont analysis for the numbers in the SLFRS Pharma Private Limited against the industry or against the competitor. It can be same for the Candy Hospital. Compare the Candy Hospital with the industry, or compare the Candy Hospital with the Colombo. Candy Hospital, because you have been given the individual financial statement of Colombo Hospital, individual financial statements of Candy Hospital. For you to make the disposal decision, You do a comparison, ratio analysis, DuPont analysis, right? And I forgot to mention one thing, when you are working on the consolidation numbers, so when you are doing the DuPont analysis for the consolidation numbers, when you take the return on equity, net profit means what? Net profit attributable to equity holders of the parent, right? In consolidation, what will happen? Once you derive the group profit, we split that group profit into two, no? Equity attributable to, once you derive the group profit, group net profit, you attribute that into two groups: equity holders of the parent company and non-controlling interest. What you need to take over here is profit attributable to equity holders. Okay, don't take the net profit in the consolidation basis. Profit attributable to equity holders. Even here, profit attributable to equity holders. But if you look at this question, there's no issue, because why? No non-controlling interest. So that net profit is equal to the profit attributable to the equity holders. Even when you take the equity figure in the balance sheet, now numerator has to be always, the profit figure has to be always equity attributable. Profit figure has to be profit attributable to the equity holders. When it comes to the equity figure, it has to be without the non-controlling interest. If you look at a normal consolidated statement of financial position, right, you are given share capital, then the parent's reserves, then you are given the value of the parent's equity. Then you take the non-controlling interest and get the total equity, right? So for the computation of return on equity, right, the equity figure, you have to take the equity figure without the non-controlling interest. Profit without the profit attributable to NCI, equity without the non-controlling interest. What is the equity figure of the parent in the statement of financial position? Clear? When you are doing the computation for group accounts. Okay, when you are doing the computation for the group accounts. But in this question, as I mentioned, you don't have that issue, because why? No non-controlling interest in the statement of financial position, no P&L. So net profit is equal to profit attributable to equity holders. Total equity is equal to equity attributable to equity holders. So there's no issue. But remember, for your knowledge even. Right. So ratio analysis, this can be tested out of any of these areas. Okay, so the questions raised in the chat box I have already answered. There's a request in addition to pre-scene what it can be tested in the examination. Okay, so the pre-scene analysis is done, right? So all the areas are completed in terms of, we took a lot of time, more than what I actually thought even. Okay. But it would be really useful for you, I believe, because we have done a detailed analysis, right? Not surface, not touching the surface, went into detail, looked at the annual reports, audit reports, consolidation scenarios, every possible scenario, even complicated scenarios we looked at. And I explained even in the ratio analysis, went into detail and explained you the DuPont analysis. Right, so in terms of the pre-scene, we are done. Then answering to this particular question, consolidation related areas, you know, in addition to that, normally in the examination, the examiners, I would say, pet topics are revenue recognition. Anyway, we discussed SLFRS 15. Then leases, SLFRS 16. That's why I mentioned that even not tested in the pre-scene, because there were, you know, you have been given the financial statements of number of companies in the pre-scene. In all these companies, there's a lease liability and the right of use assets. So that means there are leases. So even not tested in the pre-scene, leases can be tested somewhere else. Then other pet topic would be income tax and the deferred tax. Okay, so and financial instruments. So these are actually pet topics where repeatedly getting tested in the examination, right? In addition to that, what I can tell you is, now this time there was a effect, right? Even the exams got postponed because of the cyclone that we faced, right? And there were flooding. I don't know when the paper is prepared, exam paper is prepared, whether it is already finalized before the cyclone or after the cyclone, which I don't know, right? So if examiner wants to test this topic, impact of the cyclone, natural disaster on the financial statements, right? Even without the cyclone, now let's say cyclone has not happened and the exams were held at the scheduled date, even in that situation, examiner can test this topic, right? Because this is not the only natural disaster that has happened. Okay, even it has happened earlier as well. Give me 1 second. Right, so because of that, he can test the impact of this natural disaster to the financial statements. If I ask this question from you, what is the accounting standard which covers the financial reporting of the natural disasters? Can anyone tell me? What's the accounting standard? Is there an accounting standard? No, there is no particular accounting standard which covers the accounting for natural disasters, right? Right. So what happens is, natural disaster would affect the business. Whenever there's a business impact, it has to be reflected in the financial statements. So there, I can highlight some areas where it would have an impact on. One is obviously with regard to the impairment of assets. There can be physical damages to the asset, or else there won't be a demand for the product that you manufacture by using these assets. So there can be impairment scenarios. Okay. Then if you have inventory, so the inventory got damaged, or else you can't sell this inventory anymore. IS2, cost to NRV, whichever is lower. Earlier, LKS 36, impairment of asset standard. Now LKS 2, local version is LKS 2, inventory standard. Okay. Then there can be situations where you can't collect money from your customers, debtors, debtor impairment, right? So the certain financial institutions are facing for this issue now. So your credit loss provision, expected credit loss provision will go up. Okay, so some financial assets which was there in stage 1 is moved to stage 2, stage 2 to stage 3, credit impaired stage. So the credit quality is deteriorated. So you have to have more allowances, loss allowances, right? Then in addition to that, provisions. So the natural disasters create a lot of environmental impact. So if it is belongs to your operation, even though it's not your involvement, you might need to rectify the damages what it has happened to the environment, right? There can be environmental provisions, and there can be decommissioning provision that you have already provided for, but now the amount and the timing can be changed. That has to be looked at. Then due to natural disasters, some of the entities might need to close down. Okay, so you can't operate. Business is fully destroyed because of the disaster. Then you have to terminate your employees, restructuring provisions. Okay, then you have to look at whether the conditions of making a restructuring provision is satisfied. Because I told you to make a provision, there can be legal obligation or there can be constructive obligations. In terms of the restructuring provision, it's a constructive obligation. Then you have to see that whether the constructive obligation exists. To recognize a constructive obligation, there are conditions to be met as per case 27. There should be a detailed formal plan identifying the locations, businesses and people who are going to be affected. And those are going to be affected should create a valid expectation in their mind about this restructuring. So you can create that valid expectation by carrying out the plan or announcing the plan to those who are going to be affected. So you have to check these conditions and see that whether a restructuring provision is required. Okay, I discussed about the impairment, I discussed about the provisions, then the insurance claims. Now, with the natural disaster, on one side it affects the business, it affects your assets. Then if you have entered into insurance policies, you would have made the claim to the insurance company. We discussed assets can be recognized only if it is virtually certain, right? Then you have to decide whether this insurance claim that you made is virtually certain before recognizing a receivable on the statement of financial position. Whether this particular risk is covered by the insurance policy. If it is covered, whether you have fulfilled all the warranties, conditions, including the insurance policy. Okay, so then whether it is virtually certain. Normally it's not virtually certain in terms of the insurance reimbursement, insurance receivable. So if a particular company recognizes it, you have to prove that it is virtually certain. Okay. Then the going concern impact, that obviously, right, if the entity is not going to be continued, right, not going to be continued, you can't prepare the financial statements by using the going concern basis. You have to follow a different basis, breakup basis. You can't classify your assets into current and non-current assets, liabilities into current and non-current liabilities. Everything would become current assets. Everything would become current liabilities. Okay, then the measurement of the assets and the liabilities are affected. Even though there's no going concern impact, there can be material uncertainties for the continuity of the business. No going concern impact, but there's a material uncertainty for the business continuation. Then that has to be disclosed in the financial statements. Then what are the possible mitigation activities that you are going to take? That also has to be disclosed in the financial statements. So, you can hear me, right? What I explained? Can you hear me, please? Yeah. Right. So, what I can do is, it's not in the pre-scene. So, answering to your question, I explained what are the important areas in terms of the examination as well as impact of a natural disaster. What I would do is, when I am sharing this tutorial with CASriLanka, they will share it with you. I'll share a brief note in terms of the accounting of natural disasters as well, so you can go through that. Okay, right. S1 and S2 I'm not going to explain because it was done by Indunil sir in his presentation. As I said, this is SL1 financial reporting aspect. So the governance, risk, ethics and the non-financial reporting was discussed by Indunil sir in his presentation, where if you missed the session, you can watch the video which is there in the CASriLanka YouTube channel, right? But it's very important, right? So don't skip hot topic. Only thing is, as it's done, I don't want to touch it up again. Right, okay. So with that, it's a lengthy session. Hope it was useful for you. Right, so as I mentioned, I will share this PowerPoint presentation with CASriLanka to share that with you. So I wish you all the best for the examination. So ensure that you complete. This is the last session in terms of the existing syllabus. So because of that, give your best shot and complete the examination. I wish you all the best for the examination and to hope to see you as a future chartered accountant. Thank you.